Good morning, good afternoon, and good evening, everyone, and welcome to our 2024 Winter IPO Bootcamp. My name is Colin Mahan, and I'm a Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. Now, a couple of housekeeping items. Firstly, let us know where you're dialing in from in the chat. See if you have any neighbors. Secondly, we're going to open up for a live Q&A at the end of each panel. So please submit those questions for us in the Q&A function at the bottom of your screen throughout each presentation. I'll try our best to get to them all. Now, none of what we do here at the center would be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, KPMG, Wilson Sonsini, Wells Fargo, the Nareet Foundation, Walmart.org, JP Morgan Chase, BPM, HubSpot for Startups, and Google Cloud. We're humbled by their contributions and hope you're grateful too. Now I'm going to launch a couple of polls. Just take a step back and take a temperature gauge on how everyone is doing today. The first poll, how are you feeling about your business? We were just talking with the panelists earlier. I can't believe it's almost the end of the year. How are you feeling about your business right now? Are you optimistic? Survival mode, let us know. Thank you for voting. I'm going to let this go for another second. I'm going to end this poll, share those results. Well, there's a healthy amount of optimism in the room, so love to see that, but understand there's a little bit of survival mode, anxiety, and fear out there. Hopefully, the panelists will help alleviate some of those sentiments. Second poll, what's keeping you up at night? We use this data to inform the future programs that we provide for you, the entrepreneurs out there in the ecosystem. So let us know what's keeping you up at night. Is it finance, sales, marketing, scale, pivot, team, survival? All righty. Looks like finance is in the lead here. A decent mix. So I'm going to end this poll. Thank you for voting. Share those results. Looks like finance is in the lead, which is our topic today. So you're in luck. And for those of you who have scale, sales, and marketing, we will put those on the docket for the upcoming months. So let's take a look at the agenda for the day. First, we're going to kick off the program with an IPO market update, then jump to our first panel, preparing for and staying on track for your IPO, followed by a quick break. Then transition to our second panel where our panelists will share insights on executing your IPO, followed by another quick break. And then when we come back, we're going to have a quick presentation on what the new administration means for entrepreneur-related policies. To round us out on our last session, we're going to cover up achieving success as a new public company. And please note that the same Zoom link will be used for each session today. So without any further delay, please join me in giving a warm welcome to our first presenter to share the IPO market update. Francois Chadwick is a partner at KPMG and close friend of the center. Francois, welcome. Oh, your audio is off.
Colin, can you hear me?
Perfect now. All right, Francois, over to you.
Thank you so much. Thank you, everybody. As a quick introduction, my name is Francois Chadwick. I'm a partner at KPMG. I'm actually based in San Francisco, but I'm also the national and global partner of our emerging growth practice focused on VC-backed, PE-backed companies. If we go to the next slide, what I'm going to present in the next 20 minutes or so is a little bit of an outlook, but also with a recent look back on what we've seen in the IPO market, what we've seen in the VC market, and what we've seen in the private equity market. One thing I would definitely point out is there are a lot of shifting sands that we all have to be very, very mindful of. And I think we saw that in a couple of the poll questions there. Obviously, we're going to have a new chair of the SEC. That's going to have an impact on some other things within the SEC, also the PCAOB, which is the regulator for the audit firms. We're also expecting to see a lot of changes in regulations and also, what everybody's talking about, potential tariffs, where those tariffs are going to be applied, against which countries and against which industries and against which imports and exports. And we don't just have to think about that as it relates to the US. Obviously, if you start thinking about tariffs, There could be countermeasures from other countries, and that can have implications for trade all over the place. As I mentioned, a lot of shifting sands, but let's have a look at a little bit as to what has actually happened in the last few quarters. So if we go to the next slide, what we can actually see, and I don't plan on going through every single stat on all of these slides. These slides will be provided to you, and there's some of the things at the front end of these slides which we take a deeper dive in at the back end of the slides. But like I say, you'll get copies of these so you can enjoy them whilst you're having your holidays. But one of the things we are expecting is, if we look in the top left-hand corner, is there is a slight expectation, an expectation that some of the growth as we move into 2025 may slow down a little bit. And I think some of that is potentially based off the items that I just mentioned, a little bit of uncertainty around tariffs, a little bit of uncertainty around other places in the globe as well. So whilst we did have growth in the real GDP coming in through 2024, and we expect it to hit these figures by the end of the year, the forecast for 2025, whilst it's still like robust, it's looking like it may slow down a little bit. However, things change a lot, things change quickly, so we will be watching this very, very carefully. It's similar, in a similar sort of vein, we have seen a bit of a slowdown in the consumer confidence index. You can see those figures in the bottom left-hand corner. However, one of the things we did notice coming out of the last round of quarterly earnings was there was a bit of a mixed bag for retailers. Certain retailers did very, very well, and some of the retailers were not quite on target with their guidance. And so again, what this is creating is a little bit of uncertainty, a little bit of confusion, and some of that volatility. At the same time, as volatility is there, we are still seeing, good returns on numerous different places. And so, as well as that, the results coming out of the recent holiday shopping were on par, if not in excess of what was expected. So I think people are going to look carefully at all the stats that come out through the end of December, and then have to consider what's going on as we go through with the new administration into January. If we move to the top right-hand slide, stay on this slide, but if we look at the top right-hand side, looking at the U.S. capital markets, one of the things we did see, there was a very slight uptick in the amount of IPOs between Q3 and Q4, between Q2 and Q3, just one. However, the average deal size did go down by 10.8%. And I think this is just indicative of the fact that whilst the IPO market was a little flatter than we expected through 2024, there has been that cautiousness on what companies go out and how much they raise. And I'm going to dig into that a little bit more as we go through the next slides. One of the things as well I would also say about Q3 is normally a quarter which is slightly less, and with respect to the fact that August is the holidays, and so sometimes we do see these figures in the seasonality. As we look further down the slide, we can start to see the breakout there of the different sectors that actually went through the IPO, those 44 IPOs within Q3. So the largest was in healthcare and life sciences, but the largest amount from a value perspective was in financial services. And that's slightly skewed because I'll point out in one of the subsequent slides that there was one particular IPO, a REIT, that raised 4.4 billion. So 4.4 of the 4.9 was actually attributed to one actual IPO. One of the things that you can see at the bottom of the slide is the number of cancelled IPOs. And I'll dig into this a little bit more, but the headline obviously is that the quarter over quarter increased on the number of IPOs that were cancelled. And by cancelled, I mean they were planning on going out and they actually didn't go out and they pushed it into a subsequent quarter. And the value of those cancellations obviously then increased quite considerably as well. If we do go to the next slide, what we can see in the top left-hand corner there, now we're looking at the global market and the prior slide we were talking about the US market. So again, a slight uptick in the number of IPOs by volume, but again, a decrease in the actual proceeds that were raised. And I think this is obviously investor sentiment, a lighter liquidity, and a higher capital cost have all been part of the cause for those amounts to actually the actual values to decrease. One of the things we are seeing in the current developments in the IPO market is more and more companies are actually preparing for and actually running through what they call dual tracking. This is where they get the companies ready, they're preparing them for the potential IPO or the potential or a potential M&A exit. We see this quite often, and in actual fact, when we're working with companies, when I'm working with companies, what's actually happening is those companies are getting ready and they're actually creating best practices internally. From the second question, one of the things we saw was financing was the top of the list. And I think that's what a lot of companies are doing. They're like trying to get themselves internally ready such that whatever they wish to do next from a financing standpoint, they're best placed to do that. Whether that's go for another round, whether that's an exit through an M&A activity, or whether that's through an IPO. But we are definitely still seeing these spikes in volatility. Those figures have proven that out with respect to the amount of cancellations and the amount of debts that has actually, or the amount of proceeds that have actually been received through the IPO. And as I say, postponement in IPOs is occurring. It's increased a little bit. So if we look at now moving to the top right-hand corner, what we have here is the split between the landscape as it relates to private equity versus the VC landscape, venture capital landscape. And what we're seeing here over the last quarter is it's almost like a tale of two cities. On the private equity side, there's been an increase in the exit volume and an increase in the exit values. Whereas on the VC side, there's been a decrease and quite a considerable decrease in the actual exit values on those VC companies. And I think this is partially due to the fact that I think a lot of the PE companies, they've been in the portfolios for a number of years, and they've been able to get those companies ready and in a stronger position, where some of the VC companies, they actually struggled in the last few years, had to take some form of bridge financing. And then when they came to the exits, they were not in exactly the right place that people were looking for them to be. And I think that's just some of the hangover that we've been seeing through the end of 2021, 2022, when we had the SPAC market, and a lot of companies went and exited maybe a little earlier. I believe we're coming out of that hangover. We'll talk a little bit about that in the next few minutes. Actually, talk about it right now. What are we looking at? The outlook. Both for IPO, private equity, and VC, we are expecting, I strongly do expect from what I'm seeing and what I'm hearing in the marketplace, that there is a pent-up amount of companies that are looking for and getting ready to go out in the IPO market. We're actually seeing private equity portfolio companies, VC portfolio companies, they are preparing themselves. They're making sure that they're ready from the various different things that you need to do as you're going to go out and become ready. So that's not just in the finance function. You've got to have your internal controls in place. You've got to be able to report to the street. You've got to have all of that internal sort of muscle to be able to be a public company. So we're seeing a lot of that that's actually happening at a company level. We're also seeing a lot of companies where they've been able to get through the last few years. The balance sheets are like pretty robust and strong. The results that they're actually posting are actually getting better and better, so that they're actually strong, stable companies. The recent macro environments are sort of, some of them are sort of behind us. Obviously, we went through an historic year where there were so many elections around the world, and those are now behind us. So the interest rates are coming down, whether or not we see another one this year, open for discussion on that. We obviously still have certain geopolitical issues that are causing some uncertainty, but some of the uncertainty that we were dealing with at the beginning of 2024 is definitely now behind us. And I think companies are sort of looking, the markets are expected to open up. And I think we'll start to see more of that coming in through 2025 and in through to 2026. I'm feeling, and a number of my colleagues are feeling much more robust and strong about the way that we expect 25 to play out in the IPO market and the funding market. So if we go on to the next slide, please, a little bit of a deeper dive here on a few of the things I've mentioned. Again, many companies are setting themselves up and going the dual track. A couple of reasons companies would do this. One, it avoids the volatility of just going down one track and finding out that maybe that's not the best track to go for. And then you've got to retrench and come back. So companies are getting themselves ready potentially for M&A, potentially for like the IPO markets. And the other thing it does as well is if you do it this way, what we found is companies are able to be able to make sure that they attain the greatest valuation possible. Because what I've seen some companies do is they go through the IPO path to sometimes put a value on themselves and then take the M&A route because then the value has been established. But once again, companies are doing this, reduces the volatility and potentially increases the value of the company. We still see some spikes in volatility. As I mentioned, some things are behind us, but there are still some things ahead that are yet to come. Obviously, regulation, legislation, tariffs, and then on the macro level as well, we've still got some of the geopolitical tensions. However, some of the stuff's behind us. And I think once we get through the sort of first part of 2025, there's going to be a greater sense and a line of sight to how things are going to play out. And that's when we really start to think that markets will open up, companies will start to go public, funds will start to flow a little bit more. And then the last thing on this slide, I would say, we have seen these postponements, but what you will see there is the expectation, and I've got some information on the amount of pent-up potential IPOs. We are expecting to see some of those postponed / cancelled IPOs moving into 2025. So we do expect the markets to be able to open up, attract them, and then post them in 2025. If we go to the next slide, please. So some of the macroeconomic indicators. So if we go to the next slide, what we did here is we've polled a number of different folks here, CEOs of various different companies. And I think one of the things you can see is that the sentiment is that people are expecting to see things improve. However, it's still a mixed bag, and depending on the industry you're in, depending on the sector you're in, we found that there is this difference in sentiment. And I think one of the things a lot of people are still looking to see is how does the sort of the first few months of the new administration here in the US and around the globe, because we have many new parties that were elected in 2024, how do they start to put out their policies? What does trade look like? What does taxation look like? What does regulation and legislation look like? So uncertainty, but I think some folks, depending on which industry you're in, are feeling more positive, some less so. And I think, as Colin put up on the first question, how do people think? I think that level of optimism that we saw, that most people were charting to, I think that's the way you'll start to see it. One of the things that we are expecting, and has got a strong sentiment, is that we're going to have what they call this soft landing as we go through. And as it sits right now, no US recession. Maybe, as I pointed out on the very first slide, a slight slowdown in the potential growth within 2025, but not expecting sort of a hard stop in a recession. And then one of the whether or not we see at the bottom, in the bottom of the middle slide there, at the bottom of the middle part of the slide, expectations that we'll see one more rate cut. We've only got a short period of time. We'll see what happens there. And then I think as we look at some of the top risks when we've done these interviews on the sentiment, cyber risk keeps coming out. And I think one of the other items as well is, as you go further down the slide, and the AI and the new technology, what we're seeing a lot of right now is many companies have started to spend their IT spend is on AI. And a lot of companies are now at the point where they're like, well, what's the return on this? How do I actually use this AI? And I think one of the things I would also like to tie together is the cyber risk and the AI technologies. I do believe that there is going to be potential in the increase on cyber attacks and increase on cyber risks through the use of AI. And so I think those two items are going to start to come together, and you're going to see new technologies to counter cyber issues that are actually being predicated through AI. So there's going to be a lot of movement in that space as well as we move through 2025. Areas to watch: cyber, AI, and then obviously a number of the other things we've just already mentioned, geopolitical and the legal, regulatory, and tariff landscape. If we go to the next slide. So a little bit more on the IPO markets. What we can see here, if we look on the third quarter for 2024, this is the 44 that we actually saw, 44 IPOs that we saw going out in Q3. You can actually see the slight reduction in the proceeds. What we've noticed is on a year-on-year basis, most sectors witness growth in the IPO market, in the volume of the IPO market, except consumer retail and TMT. Industrial markets did really well, and the health sector market did really well as well. We've noticed this over a number of years in the health life science sector, that when the market slowed down a little bit, some of the bigger IPOs and some of the more recognized IPOs, they may not go out, but life sciences and the healthcare sector, they still go out because obviously they're meeting sort of medical milestones. They met them, they were ready to go out. And those companies are just smaller in the amount of proceeds that they raise. And that's why the stat plays out. The number of them was the greatest number for the quarter, but the value is smaller. And that's normally what we would expect to see. As I mentioned, the 4.9 billion in the from the largest in the financial sector, 4.4 of that was from a company called REIT Lineage. You can see that at the bottom there on the right-hand side. If we go to the next slide, what we see here, interestingly enough, is the number of cancelled IPOs. One of the things that you can sort of see that's quite interesting is it dropped to a low about a year ago. It's picked up a little bit. Obviously, right there in the second quarter of 2022, that was the post-SPAC market where a lot of the IPOs were ready to be going out and got cancelled just as there was the sort of the fallout from that SPAC market. It's picked up a little bit, as we've spoken about, but we are expecting that to turn around into 2025. What is interesting to me in the bottom left-hand corner is that 250 figure. That is the number of companies that are in the pipeline. And so we've got a number of them. And I think this is where we talk about this pent-up amount of companies that we do believe we know are getting ready and preparing themselves for the IPO, preparing themselves once again for that dual track purpose. But they are getting themselves ready. And this is where we see, and I hope we'll see the markets opening up, because these companies are ready to go, ready to have some further activity. So keep a watching eye on that. And then if we go to the next slide, being mindful of time. I think this slide just provides a little bit more detail on some of the largest of the IPOs, the sectors, but also talks a little bit more about where we saw the greatest performance. The top left-hand part of this slide, just to explain this, these are the companies that went out in the third quarter, So it's the 44 companies that went out in the third quarter, and the average return that they have produced within the quarter from the date they went public. So obviously this is a very small time snapshot, but you can see industrial markets has had the best results in that very small time frame, with consumer and retail having the least best. A lot of information on this slide. I've seen a couple of questions coming through that will we get access to these slides? Yes, indeed, all these slides, these slides that I'm presenting will be available for everybody. If we go through to the next slide and being mindful of time, a few things with respect to the PE markets. One of the things that we've seen that's an interesting trend is the PE markets, they've been holding on to their portfolio companies for an extended period of time. You know, companies that they thought they may have exited in 2022, 23, and into maybe 2024, they've been holding on to them. And so what we're expecting to see is either increased sales between PE funds, or we're actually seeing certain new things that are occurring where PE funds are actually setting up extension funds and then selling them from their one PE fund into their next extension fund and holding on to them for that extended period of time. So we've seen some of that, but we do expect to see that the PE markets, PE exits will continue into 2025, as we mentioned earlier. Moving on to the next slide, a little bit on the VC market. The VC market, as mentioned, there was a slowdown and some of the results in the third quarter, but the expectation is that they will open up and that we will start to see more of the VC funds actually look to exit. I think whether that's going to be through M&A activity, we do expect to see more M&A activity. We've sort of corporate M&A, larger companies coming and buying some of these VC-backed entities, but we also do expect to see more of the VC companies going out on the markets, as once again, Q1, Q2, Q3 into 2025. And on to the last slide. Again, a little bit of repetitiveness here. Some of the things that we've seen was a little bit of slowdown in the markets within the VC exits. But what we're expecting to see is, I think there's going to be a world in which some of the VC companies, whether they go out and go public, we do expect to see more PE activity where the PE funds would look to actually come in and take a sizable, if not full, ownership of some of these VC-backed companies. So we'll see corporate acquisitions, we'll see PE acquisitions, and then we'll see the VC exits into the IPO market. This is going to be a mixed bag as we look through 2025, but I do believe we'll see a lot more activity in this space. We'll go to the next slide. I think that's just a nice, pretty picture of myself. So again, Francois Chadwick, I'm a partner based in the San Francisco office in our private enterprise practice. I run the emerging growth practice within that. Colin, back to you. That was a very quick run through, but I do believe, and I don't want to believe that I'm the only market maker for 2025, but I do believe we'll see a strong 25 and into 26.
I love that, Francois. Thank you for that informative and optimistic IPO market update. I too, and most of the attendees are riding the optimistic wave. So really appreciate that. And for everyone who was asking, yes, you will get the slides as a follow-up to this. So up next, our panel of experts will cover preparing for and staying on track for your IPO. So please join me in welcoming Claudia Van Muntz, who's the chairwoman of NACD NorCal, and she's also our moderator. We've got Liana Whittleton, partner at Wilson Sonsini, and coming back to the stage, Francois Chadwick, partner at KPMG. Welcome, team, and Claudia, over you.
All right, so I'm going to start by a very brief introduction and then ask Liana and Francois to also talk a little bit about their experience. I mean, we're so blessed to have such a great expertise on this panel, on this incredibly important discussion. Again, I'm Claudia Femmans. I've been in the venture as a venture investor for a couple of decades now. And I also am a faculty at Stanford Business School where I teach venture capital and entrepreneurship. So this is an important subject for my entrepreneurial student as well. And as Colin mentioned, I am chair of the National Association of Corporate Directors, which also including private venture-backed company directors. And, over the years, I have, sat on board a device company, took private company public company private. I was the corporate vice president of M&A for IBM. So we acquired tens of venture-backed company, as Francois was talking about, the M&A part of it. And it's such an important strategic milestone for a company, for you guys out there, for our CEO. It really all depends on your maturity, your ambition, what is the market. And that's why it's so important to get that update from Francois and, just really have to weigh in the advantage and disadvantage of IPO. You get the scale liquidity, but then you get substantial obligation. And I can say that because I also sit on many large public company board. And I can tell you the regulator is part of your life. Once you go public, that is a huge burden you have to answer to. So I'm delighted to be here to have this discussion. I'm going to pass it on to Francois and then Liana to briefly introduce themselves as well.
Fantastic. Thank you, Claudia. For those that maybe weren't at the very front end, Francois Chadwick, I'm a partner in KPMG in San Francisco. I run nationally and globally the emerging growth practice within our private enterprise practice. I rejoined KPMG a year ago, and I was away for a number of years. And in that period of time, I joined a small company called Uber and helped scale it. I put it in 96 different countries, helped scale it, got it ready and helped take it public, built the finance function over there, and had many fun and games with regulators and policymakers and all sorts around the world, both pre and post public. And then I was the CFO of an EV charging company. I took that company public, and then eventually sold that company to Shell. And then prior to returning to KPMG, I was CFO of a defense tech company that was in the AI space, AI and defense tech. So I've seen various different industries through growth and taking companies public and raising money and all sorts of different things. So great to be here. Thank you, Claudia.
Thank you, Francois. Liana?
Great. Liana Whittleton. I am a partner at Wilson Sonsini. Thrilled to be here. Been with the firm about 15 years now, doing primarily company side representation. So I help a lot of companies with those private fundraising stages, right, as well as prepping for an IPO, going through the offering, and then of course staying on as counsel once you are public. And Claudia's right, you get through the gate and there's a whole lot more you have to do, for better or for worse. So thrilled to be here. Nice to meet everybody.
Thank you. So let's get started here, Francois. Let me start with you. I mean, that was a fantastic outlook, and hopefully everyone is optimistic by the information you share. But tell us a little bit about in the current environment, why do companies decide to go public through an IPO? And of course, as I mentioned, there are advantages and disadvantages to this approach compared to what you mentioned, the dual track of M&A or just continue to raise funds from private equity or venture capital. Go for it.
Yeah. So I think I want to make, like what Liana just said, is incredibly important. If you're going to go through the IPO process, it's not just getting ready and going through it. It's once you're public as well, you've got all these other things you've got to consider. So it's you've got to consider the full journey. And I'm sure Liana, you can jump in at some point and tell a little bit about some of the later stage stuff. And I think there's probably another panel on that as well. But a lot of companies wish to go public. I think there's various reasons. I mean, you create the liquidity moment for your investors. You create it for the CEO, the founders, and the employees. It also so there's that liquidity moment. there's also, it sort of forces the company to make sure that they are ready and they sort of grow to become a certain level of maturity, because you got to go down that path to be ready and then become and act and be a public company. There is also the sort of the cachet of being a public company. And so, there's people to, you are a public company, you're a public company. It's like you've come into a club, you've joined the club, right?
Ego, Francois.
Yeah. And then, but as well as all of that, I think there are certain reasons why some companies do go public, right? They're like in certain spaces, in certain regulated spaces, it's like easier if you are a public company. You are recognized more if you are that public company. I see that in some of the life sciences spaces and other regulated spaces as well. But there are certain things that are beneficial if you're raising debt, you're raising other things. Sometimes it's easier if you're a public company because people are able to understand more about your business so that you can then go out and raise that additional funding, debt or additional run-ons for equity as well. So I think there are a number of reasons one would wish to do it. And maybe Claudia, or somewhere down the line, we can talk about some of the things that people may not wish to do it for, but those are the reasons, Claudia, I would say companies look to do it.
Yeah, that's so true. And it's so on. I mean, never underestimate that public recognition of being a public company, right? It's a big part of the decision. Now, Leanna, I always tell my students, if you don't get a good counsel next to you, you pay later than paying now. So tell us about the key stages as you work with so many companies that went IPO. What are the key stages involved in that IPO process?
Thanks, Claudia. And I'm going to break this into 4 categories, more based on the management role and the level of effort, because I think that's probably what you all are most focused on as opposed to some of the technical nitty-gritty. So bucket 1 is the lead up to the IPO. And that can be anywhere from 18 months out to 1 month out to filing, right? And I think the real focus for you all is, focus on your operations. Is your house in order, right? Do you have all the executive positions that you need filled at the right level, right? What is the relative experience of your management team in terms of going public or being ready for being a public company? What does your board composition look like? Do you have holes you need to fill? Audit committee expert, right, is a common one that you're looking to focus on. And board members, you don't just want to drop in a month before filing. You want to find the right person, the right experience, the right fit and cadence with the rest of your board. And then there's bigger picture. Is your finance and operational processes all in place, right? Can you close the quarter on time, right? Do you have the right policies in place? You might have policies sitting on the shelf, but does your sales team actually know that they're there? Are they following those policies, right? What are your information systems, your data security infrastructure look like? Is that really all up to snuff in the scrutiny of public markets? And I think of this phase as good work for any growing late stage private company. So even if you're still a ways out, these types of investments are just healthy for the company. So it's not money or time invested in something that doesn't get used and starts to get dusty because your IPO got, delayed due to market, right? These are things that are just good, I think, hygiene overall. And so you can say we've done these investments just because we're a stronger company. And it also does sort of help strategically position us. So when we do say go, you're not trying to do the operational and the offering stuff all at the same time, right? So category 2 is when you're actually in registration, right? And this is, I think, the most intense portion of the offering for management. You have your day job, right? Not everybody at the company knows that you aren't spending all your time on your day job. And instead, you're spending most of your time talking to me, right? Talking to the banks, thinking about your story. My team will send you a backup tracker that is this long, and you're going to say, why are we chasing all these things, right? So there is an incredible amount of work, and this is primarily the lead up to the first filings when the majority of a lot of that work gets done. And so you are balancing an incredible amount of things, right? So that's where if you can clear out some of the operational stuff, some of the diligence, the how do we do things, that makes this piece a little bit less painful. Plenty of companies do it all at the same time, right? But if you've got the opportunity, and I think we have a lot of companies who are staging and waiting, that's sort of how you can bifurcate this, right? I don't think there's value to drafting a business section today and sitting on that, right? But there can be a lot of value in terms of building out your organization. I think the next bucket, right, is your public filing. And so practically, there's this huge lead up to the initial confidential, and then you get into this cycle. You wait 30 days, you get a comment letter, about 2 weeks later, you get back on file, wait 2 weeks, have another, spin as you do another filing. And so there's a cadence to it. I'm putting all that in the same bucket because the public filing is kind of that next inflection point for what management gets to do. And with that public filing becomes all of the shareholder engagement, right? Now everyone officially knows, and it may be the worst kept secret in the organization, but now you're actually engaging on an IR perspective. You're asking for lockups, you're getting consents, right? You're just seeing all the inbound because you've described your business in a certain way, right? And so that does tend to create its own additional work stream, right? That maybe you weren't thinking about before. At least on the operational side, on the technical side, you're in a waiting period, right? So there's no filings during then, and you're doing all these shareholder engagement, corporate governance focuses, and then you launch the roadshow, right? And so that is when management is running around. Increasingly, it is on Zoom, right? I do think COVID very interestingly made that process more efficient and also shorter. We are seeing people go back to in-person meetings. I think that can be compelling. But some of the timing, the cadence, the length of that has shifted a little bit. But you essentially go on your marketing tour, right, of the company that ends in pricing, and then you end up closing thereafter. And so I tend to think of that as that fourth bucket or category of activities. And then, of course, you're public, right? And then you have your first quarter upon you, almost always sooner than you really expected. But that's how I tend to think about it, is in terms of allocating your work and your responsibilities.
Yeah, that is a great summary. I mean, I totally agree. One of the first thing you got to think about is getting a really an audit committee chair, right? Because now you need to put all your financial reporting in the structures that will allow you to do that. But I will add also a compensation, committee chair, right? Because how do you share and pay everyone, the co-founders and all the employee become another huge issue that you better get it sorted out because the investor will want to know. Now, Francois, obviously the financial metrics and benchmark is what the investor want to look at when you start this process. So tell us a little bit more about that. If you have some specific example of milestone achievement that will give the investor the confidence that the company is ready to go public.
Yeah, let me take a step back from that, Claudia, and I'll come to answer that question.
All right.
But in order to answer that question, and Liana mentioned it right at the very tail end of the four buckets that she mentioned, which was like, once you're public and you got to report, and you got to report on your first quarter, right? I think one of the things is, and it's sort of in that first bucket when Liana was talking, but within the finance function of the company's got to be able to close the books in like that 4 or 5 day window, and then be able to do everything it's got to do to get to the point where it can produce those financials, produce those metrics. They've got to be complete, they've got to be accurate, they've got to be timely. You can't be making adjustments and things like that. And I think so, on the journey of those 4 different buckets, there is a lot. And I think, Liana, you would agree with this. There's a lot in that first bucket, right? Which is very sort of like the internal nitty gritty of how the company operates. What I always found from my experience is, a company could like sit there and go, okay, well, it's the finance function. So we're going to focus a lot of time and we get the finance function. The finance function is there up and running. But it's that fibrous tissue within an organization that I think is even more important. It's the way the finance function talks to HR. It's the way finance talks to sales. It's the way the legal team talks to the finance function. And if you don't have that fibrous tissue around the whole company, then this is where you can have certain failings. And so it's like, think about everything, and think about all those numbers, and think about all those numbers are gathered. Think about how every piece of communication through not just legal, but accounting, but also through comms. And maybe we'll talk about comms and communications a little bit later, Claudia, but you've got to make sure that you've got all of that and you can do this, and you got to do month after month, but especially quarter after quarter, and you cannot miss, especially like you go public, any company goes public, if you've got to meet and beat, and by that I mean meet and beat your guidance for those first 4 quarters, because that's what the market's expecting. Otherwise, in my prior discussion, you sort of saw some of those returns could go south instead of in the way you want them to go. on those returns for the first few quarters. But Claudia, coming back to answering your question, I think what's actually happening now is, you know, back when it was the early days of sort of Uber, it was like growth at all costs, and that was the market, because there was 0% interest, right? Money was free or close to free, right? And so, you know, a lot of focus was always growth on that top line, right? What is that top line looking like? How fast can you grow? How many more users? How many more whatever, right? Just that was a lot of the focus. Obviously, very different market now, very different dynamic. So as a company, you've got your financial KPIs, and then you're going to have your other KPIs. From a financial standpoint now, I think everyone is focused on what's the growth looking like on the top line? What does your revenue sales look like? How do they grow? What's your gross margin looking like? And how is that comparable to the industry and your other competitors? What's your EBITDA or path to profitability? How long is that going to take? And what's the variability of that? And then fourthly, how strong is your balance sheet? What's your cash balances look like? What are when you've got your proceeds, what are you going to use those proceeds for? That's always going to be a question. You go public, you raise the money, what's that going to be used for? But then I think when you look at the non-financial KPIs and the metrics, and a word of caution for everybody here, be careful when you do your non-financial metrics, because the SEC loves to ask questions as you're going through the process, and Liana will know this time and time again. If you've got these non-financial metrics in any of your, when you file to go public, they're going to ask questions on how they tie those back to, you know, some of your financials, and they don't want to see any of these filings becoming sort of marketing documents. They are not a marketing document, and they really don't like that. But you've still got to have KPIs. And so then you've got to look at what your competitors are doing. Is it like, you know, what's your ARR? What's the increase in your ARR? What's the number of seats that you may be selling? What's the number of users? What's your churn? Things like that, that you've got to understand and work out what you're doing in the industry, what your competitors are doing. I think, Claudia, an interesting thing, and slightly taking a left field 30 seconds here, one of the things I'm finding interesting is what the KPIs are going to be for the AI industries, right? Right now, everybody still talks about ARR as it relates to AI companies as though they were SaaS companies. However, if you start to pull apart the financials of some of these true AI companies, they are not SaaS companies. The way their costs run and the way their inputs and the outputs and the tokens and everything else in this space are operating, they're not SaaS companies. So how that's going to land from a KPI and a metric standpoint in the coming 6, 8, 12 months is going to be an interesting thing to see. But 4 key metrics, I would say, for your financials that everyone's looking at, and then the KPIs as it relates to what your competitors are doing. And there's nothing wrong being the lead with a new KPI. But the one thing I would say, and Liana, you know, jump in on this one, please. The one thing I would say is if you start to use a KPI, don't keep swapping it or dropping it or changing it. Liana, you might want to comment on that. Right.
No, I think that is dead on. And so when you're talking about being ready, right, depending on market, depending on your competitors, your KPIs themselves may vary, but what you need to know internally is consistency. How do we calculate this? Did we exclude our big customers? Did we think about the parameters, right? If we're talking about a recurring customer, are we thinking about our land expand model the right way? Because inevitably 2 or 3 quarters out, you go, actually, I'd really rather cut the data this way because it's more favorable. And unfortunately, I'm going to be there waving my finger at you saying, sorry, you can't do that. We can't modify. You're going to lose credibility. And so now your number is going to go down. You hadn't thought about it, but we can't just play with the numbers, right? That undermines your ability to report. You will get an SEC question. You will get investor scrutiny. So I do think consistency is actually probably the most important. And you're going to kind of hear us keep harping on the beat and raise, right? And the model. You know, you are going to be measured by a different yardstick once you're public. And so really understanding what you need to present and what the guardrails are for that is going to be a bigger driver of your success than even, frankly, how you're performing against the internal models, which is probably how you've all been thinking about it historically. And so being able to be consistent, not changing your calculations, not seeing something go down in an unanticipated way, right, is really, really important. Or if you know that you'll hear lumpiness, right? Like if in fact you don't have a consistent story, making that part of the story up front, right? You can get ahead of a lot of these things. Say, look, we have some government sector, very unreliable, long sales cycles. We can solve for that, right? So it's really, I think, understanding what the drivers of your business are and what is consistent and what's not. Otherwise, as Francois said, right, you can't get 3 quarters out and say, let's just change our term. Let's add a new metric because this one looks good and that one's really not performing as well.
It's such an important point. By the way, I'm very surprised the SEC only got mentioned about 20 minutes into this conversation. I always tell the entrepreneur, just go read a proxy statement. You realize there's nothing flashy about, being a public company. Now, one of the things that is very, very, on the top of mind of entrepreneurs and founders is how does all this change the company ownership structure and the whole governance? Liana, do you want to take a shot at that for us?
Of course. So, it's interesting. On the one hand, at IPO, same as probably your last late stage financing, you're probably selling about 10% of the company, right? So from an immediate dilution perspective, not a whole lot of change, not that different from what you might have been doing as a private company. But on the flip side, right, fundamentally, once you go public, your structure is different. All of your preferred stock is going to convert to common, right? You just have one trading class now. And that has downstream impacts like your employee retention, right? So up until now, you've been doing options at the 409A. That's a lower price than your preferred. When all that gets conflated, right, the economics are changing, how you're incentivizing people are changing. The presence of a public market, the ability to sell your shares is also going to affect your equity component. And so I do think companies often don't, and Claudia mentioned this, the comp consultant, having a strong comp committee chair, that actually is a really important part of this overall process. And it's secondary, right? But also really of key core importance to you being able to run this business, right? Because your employees tend to be the lifeblood of your operations. It's interesting earlier, one of the drivers of IPOs, often it is employees, right? You start running into retention issues because folks are fully vested and they can jump ship to a public company, a publicly traded stock, and get liquidity. And you really need to get them to stay with you, right? And is staying with you changing your comp structure or giving them that public company liquidity in your stock as well, right? So I think that's kind of a big piece that changes just how you think about and run your business. Certainly, yes, it's only maybe 10% in public company stockholders, but those are a vocal 10%, right? And over time, of course, once your lockup comes off, people will start to sell down naturally, right? And so you'll see that composition change over time. But the scrutiny of public company investors is different, right? So as a private company, you've got your VCs, they're on the board, they want the annual plan, right? They want to know where you're spending your money, but they're focused on long-term growth, right? And they're kind of understanding they're making an investment in you for X period of time to see if you can make it. Public company investors are not, measuring you in that same way, right? So they're going to be much more focused on short-term growth, right? They want to see quarter over quarter, are you doing what you said you were doing, and not really as focused on that long-term development. Right. So structurally, we actually will put in a whole bunch of protections for you, and they're called defensive measures. And we set up your corporate governance structure in a way that's intended to try and protect management and the board from some of the pressure you might get from short-term investors to give you some operational flexibility in being able to try and run this company for the long term. But you'll see that pressure, right? I mean, certainly in down economies like we've seen recently, a lot of activist activity, right? It's not hard for an activist to say, hey, your stock price isn't performing. And even if you've been hitting all your metrics, the whole market went down. So they have this easy story to come after you, even though you're doing what you've been doing, right? And so structurally, we do try and put in place as much, protection or buffer as we can to try and safeguard you against some of that activity, because it will come, right? It's not an if, it's a when in a lot of ways. And so you will see some of the changes there. The forefront of that tends to be dual class stock, right? And that's something that you'll consider early on is, do you have the right equity holdings vis-a-vis your founders or your early investors to make that interesting and attractive to really properly insulate you from challenges at the board level that would affect your operational capacity?
So often that the CEO are not even thinking about that, right? As they go through this wonderful aura of going public, they don't realize suddenly they are now, become a target that they weren't before for activism, for, analysts that will run their model regardless of their knowledge. So there's a whole new set of obligations and risks associated when you realize cyber, as Francois mentioned, is no longer just an operational risk, it's now a compliance risk that you have to spend all that money against and be ahead of the game rather than just being preventive. These regulatory bodies clearly is going to be a big part of a public company, but through the IPO process, what are the advice you have for the CEOs in terms of the regulatory bodies that they have to be, dealing with? Francois, I'll go to you on this one.
Yeah, and I think, Claudia, I'll answer this. I'm going to drag Liana into this as well, but I do want to go back as well to talk a little bit about, which we'll do after, if you don't mind, go back about what happens to the employees when a company goes public. If we go back to that. What I have found, though, with all of the three-letter regulatory bodies that are out there, and probably more letters than that as well in some of them, this is where I believe the accounting teams, the auditing teams, and the legal teams, they should work really closely together through an educational process with the founders and the C-suite of every single company that's going to go out there and be a public company. And I think this educational process should be to make sure everybody understands what each body does, right? What does the SEC do? When are they involved? How much can they get involved, right? What does, depending on which business you're in, the FCC, right? What do they get involved in? Like some of my past, what does the DOJ get involved in, right? There's certain things like that. What are they involved in? How could this impact you? But then not just how could it impact you, but then how, as the new CEO, the CEO of a new public company, how should you be acting, and what should you do, and also what you should not do, right? And Liana, I'm sure you've got many stories about things that you just cannot say once you are a public company, and there's story after story and some big names on some of those things as well. But if you don't have that education process, and it's got to be for not just the CEO, I think it's got to be for everyone who could potentially have an outward-facing voice, or a platform on which they could speak, because otherwise you could fall foul of something, and it could be quite detrimental to the company, right? And I'm sure, like Liana, I'm sure you've got many stories on this, right?
Oh. Well, we'd love to hear some of those, Liana. I always tell the CEO that is when you need to add to your board somebody who has a public company experience, a CFO, that have dealt with the regulatory front in the industries that you're in. So tell us about, how do you evaluate the corporate governance when the company is ready to go IPO? What do you advise the CEO to be ready for from a corporate governance perspective?
Sure. So Francois just hit on a whole bunch of things. I'm going to start with publicity, because that is almost always the first presentation that I do. When a company says ready to go public, I say, great, schedule a meeting with all your execs and your board. We need to talk, right? And I think the easiest footfall is you're a big company, right? You put out press releases all the time. You talk about how great your products are. From time to time, you announce your financings and what your goals are, right? You give media interviews because you're trying to grow the publicity and the prominence and the visibility of your company. And, my thinking is always, I don't want to clamp down on that, but I want you to know where the pitfalls are, right? And there are just, I think the IPO path is littered with stories of an interview someone gave 6 months ago, and they didn't know it was coming out now. And then we filed publicly, and now we have an interview. And guess what? The metrics and the numbers don't quite line up, because 6 months ago, we hadn't refined those models quite yet, right? And now we're scrambling to do a free writing prospectus to reconcile it and adopt some of that language or differentiate it, right? And so I think all of these things are largely solvable. My goal is I never want you to be surprised, right? So it's, okay, here's the pitfalls. Here's what to think about. If these things happen, we'll manage them in the ordinary course, but be aware of where the big risks are, right? So I think publicity is a big one. I was talking a lot about the operational readiness at the beginning. Frequently in IPO diligence, we start doing, questions, looking at policies, and we realize that we've got a voluntary OFAC disclosure, right? Because in fact, we weren't tracking IP addresses quite as well as we could have been. Or we didn't realize someone from Iran downloaded a free copy, right? No money involved, but we shouldn't have made that available, right? And so I think that's actually something that's extremely common, that we kind of focus on. You'll hear a lot of times the banks will say like the reputational issues, right? So sanctions, cyber, privacy, right? Those are the areas where we're going to spend a lot of time because I want to get ahead of that. I want to self-disclose or correct something before one of those 3 or 4 letter agencies comes knocking on your door, right? Part and parcel of that tends to be the marketing work and how you're selling your product, right? And it was fine up until now for your website to say, we are the most used, we are the best, we are the leading, right? Francois kind of mentioned the FCC, right? What can you actually say? Can you validate that? How accurate really is that, right? I remember a couple of years ago, pioneering was the hit word. Like, you can't prove or disprove pioneering. You can maybe prove best or leading, but pioneering, so there are these games that we play that in some ways you guys will roll your eyes at me, right? Like, why are we focused on this? But my goal is to not have that inquiry, right, on federal letterhead to make you say, oh, now we're focusing on these issues, right?
Coming at you, yes.
Exactly. I think another piece that probably most of the folks listening are going to run into, right, is you're going to potentially upgrade your audit, right, to a SAS 100 audit. You're going to hear FASB. Maybe you never heard that before. Occasionally, we will find significant deficiencies or material weaknesses, right, as we really refine and tighten your financial processes. And again, I don't view these as black eyes. They're very common. We want to find them first. We want to get ahead of disclosing them. We want to fix them, right, before you get out there and somebody else is asking questions. And so some of this can feel almost like you're under attack, right? Like banks are asking questions, the lawyers are asking questions, but we're all on your side, meaning we want to build out, suss out the issues, and really have the strongest company we possibly can to bring you out, right? As Claudia mentioned, we hadn't really said SEC a whole lot here, right? SEC is obviously a very active, big part of this. And the way I would think about it, right, is the SEC's primary mandate is disclosure, right? They are not trying to stop companies from going public or, depending on the administration, actively facilitate. But really their goal is, if you're going out, what is the right information you have to provide to your investors so they can make an informed decision to buy your stock, right? So almost everything about the SEC is disclosure. So you'll also hear the people in my seat saying, you ready to talk about that, right? Like, you can do that, but now we have to describe that. How does that look? How does that feel? How does that play, right? And that tends to be a driver from that point. You've also got the exchanges, right? Nasdaq, NYSE, and a lot of your corporate governance is actually driven by the exchanges and not necessarily by the SEC. So I think you'll hear us conflate those often when we're talking to you, but the audit committee independence standards, for example, it's a Nasdaq or NYSE requirement, not an SEC one, right? But these rules do all sort of play together. And then one I think the banks are tending to be hyper-focused on, companies don't focus as much as FINRA, right? And this is your trading platform, right? Who's trading in your stock? Who's got relationships that are permissible or not? And in the lead up to the IPO, FINRA is a bank issue, right? The banks will all clear FINRA. They will do submissions. As the company, you don't have to worry about it at all. Once you're public, FINRA letters, right, tend to be the ones that say, we noticed unusual trading, and here's the list of everyone that bought and sold. And your goal is to never look at the list and see a name right? Like that becomes an issue. So those, I think, tend to be the big bodies you're going to hear about. And so often I think folks in Francois' seat or my seat won't talk about it in terms of the agency. We'll talk about it in terms of the issue that we're trying to get ahead of. But, that disclosure and that correlation often comes hand in hand.
Such important part.
I think one other thing to bear in mind as well is you're going through this journey and you're going from being a private company into a public company. Obviously, there's the D&O insurance, directors and officers insurance. And, a lot of what Liana's talked about, a lot of what Claudia was, you were alluding to around governance and things like that. The more of that you have in place, the more of that, like even if Liana mentioned, you've got these material weaknesses in your financial statements and you've got a path to remediation and you can explain that path. That helps when you're having these D&O insurance discussions. If you don't have any of these things in place, when you start to come to have those D&O insurance discussions, get ready for a big surprise on the cost, right?
Yeah.
Because I will say, I believe the cost of D&O insurance has come down from 2021, and it's at a more acceptable level right now. But still, the D&O folks will take a good look at the company and want to understand a lot of what Liana's talked about and what Claudia's talking about with respect to governance. Putting that in place, it's not just good for the agencies and good for the disclosures. It's actually good for best practices and actually will create, in the longer run, savings for the company.
It is. So I always ask before I even consider a board, what is your D&O?
Oh, yeah.
Insurance, Francois, if it's 10 times my worth, then I'm okay with it.
Yeah.
As long as it doesn't hit my my own pocket. It's such an important factor. Is there anything else, Francois, that you see as the challenge that the company has on the compliance and regulatory requirement through the IPO process that we might not have addressed?
Well, maybe just I'll take a step back there, Claudia. And I think coming back to governance, I think one of the things is, and it's back to education, is like, when you start to put the governance in place and once you've got these committees, right, there are certain steps that are incredibly formulaic, right? And where that can go, like, can it have a bit of a butting of heads, is where you've got a very entrepreneurial company that's been running at a fast pace. They're growing, suddenly like, hey, now we're public. And then you've got to sit through a 2-hour committee meeting. And then you've got your board, you've got your audit committee, you've got your nominating and governance committee, you've got your compensation committee. You might have set up other committees as well. And you've got to go through all of this. And there's some, I've seen folks suddenly go, this isn't adding value, right? Well,
That's the point.
there's a difference in the view of value, I think. And so making sure everybody understands the reasons and the rationale for them to be there. And frankly, coming back to your very first question, Claudia, that you asked me about why companies go public. And the other side of that was, well, if you're going to go public, just know this is a must. There's a lot of this stuff that is not an optional, it's a must. And so that's got to be part of your equation as you think about, do you want to be a public company?
Yeah. I mean, it is actually really helpful for you to, put a credible structure, governance structure together, right, Liana? Because the investor look at that, in terms of the reputational component of the people that have signed on, right? Like I said, I want boards that has the D&O insurance that is 10 times, 20 times my worth, so they can cover whatever happened. So a lot of time, constructing that for Liana, it is there's so many multifaceted aspects. It's beyond just the expertise, is also, the reputational component. These people have the expertise that most of the venture-backed company management do not have, right? Mm-hmm. Because many of them has not been a public company CEO before or be at that senior level to deal with that. So it really is a important consideration that too often the CEO are not thinking about that until they get right at the door and they're like, whoa, do I have to worry about that? Do you find that to be the case for you as well, Liana?
I think you definitely do, right? I mean, one of the reasons that an IPO is so compelling is you've got this access to the capital markets, right? Like your capacity to fundraise, you will take 6 to 9 months to do your IPO. You can bring a convert deal in like a week and a half. Like it is, once you are out, like the opportunities to raise capital, the speed with which you can do it, the efficiency to it is extremely compelling, right? But I think what is important for management teams to understand is with that capacity to access those funds, right, comes the corresponding risk profile, additional scrutiny, right? And kind of just enhanced focus on process. And I do tend to think, it is rare that we have a company who says, oh, we have no FCPA policy. I need one of those, right? What does happen, you say, oh, we've got one. You say, great. Do all your salespeople know about it, right? And they say, oh, of course they do, right? We have it on our, internal drive. It's all there. And, we say, great. Well, as part of our internal process, let's get everyone to certify that there are no side arrangements and everything's exactly in the OEM agreement.
Yeah.
And then you have someone raising hand like, actually, I can't sign that, right? So a lot of this is having enhanced procedures in place so that you can suss out the things that might be a problem, right?
Right.
Because as a private company, that happens. You say, gosh, let's talk to that person. Let's do trainings. We'll solve for it, right? And your risk profile is relatively controlled. As a public company, it's just that much greater. And that's part of why you have all of this focus and attention paid. And ideally, it's lip service because you're doing everything properly, right? But it is meant there to be a fail-safe to protect management. Because at the end of the day, we've had situations where CEO had no idea what was going on, but something happened, right? It's a disclosable issue, and now you've got a little bit of egg on your face as well, right? So we're trying to keep you out of those situations.
It is such an important point, especially for M&A, right? A large company like, IBM, which is a very active acquirer, things that you might not be a target for, we will be. We with our deep pocket become a target of things that you think, will be irrelevant for you as an independent private company. So the due diligence aspect of that is much more strict than what normally a private company will go through. I am running out of time here. This has been incredible. So before I open up and have Colin come on to help us with the Q&A part, what will be the takeaways that you want? What would be just a couple of things you want to make sure that our audience walk away with in terms of preparing for IPO and going through that process? Francois?
Yeah, I would say maybe top 2 or 3 things for me. One,
Okay.
if you are planning to go down this path, start to prepare as early as possible. Getting ready and having test runs and being able to put everything in place and finding out where things can fail. Where I talked about it earlier, if you can't close your books in 5 days, then make sure, if you're closing your books in 15 days, how do you bring it down to 5 days? What does it take to get to that point? We never talked here on this particular call about Sarbanes-Oxley and internal controls, but you've got to start putting internal controls in place. You can't wait to go public and then start to put them in place. You don't need them to be signed off for another year or so after you've gone public, but you can't go public without them. You've got to. And then the last thing I would say, so just making sure you're ready, making sure you plan ahead of time. There are so many different things that need to occur within a company to actually be ready to go public. Where I found the best practices or the best thing I've seen where companies do it the better than others is where you have some sort of dedicated PMO, a project manager owner, a project manager officer, a person who's in charge of it. And this is all they do. They wake up day in and day out and think, where do we stand on the journey? And they cross everything. They cross finance, legal, HR, operations, sales. They are in charge of making sure everything gets ready. And I've seen best practices. If you're going to do that, make sure you've got someone who's got good PMO skills, but I've seen it to be really, really helpful.
Such an important point. Liana?
Yeah, I do tend to think when we give these presentations, I'm trying not to scare the crap out of you all, right? Like IPOs are exciting. They're a huge branding event for companies, right? And I don't think you need to be perfect. I don't want the takeaway to be, oh my God, we have so much work to do. We could never get there, right? But I think particularly in the legal function, what you need to be clear-eyed about is where are you performing and where's there work to be done, right? Like, and I think as, a compliance matter, right? As head of legal, it's more about knowing where the pitfalls are. You don't need to fix all of them before you go out, but be really clear-eyed, right? You never want to I had no idea, I was surprised. Like those tend to be the really uncomfortable conversations. Hey, this isn't perfect. We need to work on X, Y, or Z. We can do that, right? And certainly the more time you have to start doing some of that, the better. We can certainly do it in the course of the offering, but a lot of it is really just knowing the pros and cons of your organization, right? We have a lot of big tech companies that aren't doing everything exactly as they should. And like, that's known. That's part of why you got to where you got. Like, that's all, I think, perfectly acceptable. It's more about just understanding where those holes are so we can fill them at the appropriate time, right? And Francois will tell you, this one, fix today, that one, have a plan, right? I will tell you the same thing. And a lot of our job is helping you calibrate what is really the most important stuff here, right? And what is the stuff we can solve for over time? Think about it now, right? Just don't be surprised.
Just that's so good. I mean, all I can say is make sure you have the right partners around the table with you, because whatever you're seeing for the first time, these guys like the Francois and Leanna have seen it so many times. There's such a muscle memories that these good partners bring to the process. So with that, I'm going to pass on to Colin to do the M&A Q&A session.
Awesome. Well, thank you, Claudia, for leading such an amazing discussion. Francois, Liana, always learning so much from you. So thank you all. For those on the call, if you've got questions, drop them into the Q&A box at the bottom. We'll try our best to get to them all. All right, let's see. Let's see. Francois, part of your key takeaways was to get started early. And there is a question asking around when do you think people should start setting up data rooms?
Good question. In my view, I think setting up a data room should be done as early as possible. And here's why, right? Whether you're on the path to an IPO, whether you're on the path to another exit through an M&A, or whether you're on the path to potentially raising the next round of funding, whatever that may look like, you will need to have a data room. And I think what you've got to do is when you set up your initial data room, you've got to take a critical eye on everything that gets put into that data room. And in that first instance, there's going to be things in there that are going to need a lot of refinement, a lot of redoing, a lot of tidying up. But essentially, eventually, you should get to a point where you've got a data room that all that needs to happen is just needs to be updated and refined. And then you've got something, and you'll be sort of 40, 50, 60% down the path for anything that may happen at that point in time. Now, depending on what path you go, is it another raise? Is it an exit through an M&A? Is it an IPO? That additional X% will then have to be added in. But having everything all in one place, clean and tidy and ready to go, absolute best practices. The sooner the better. I tell every company to do it.
Yeah, I
Awesome.
think that's a great point. And I think to add just my context to it, I don't think that means that you have to hire a third-party data room provider, right? And like keep them paying on a monthly basis for access. But do you know where all your contracts are? Are they all in one place? Are they all signed, right? Like I think it can be internal as much as external, but it really is the sort of general hygiene. Like, do you know where everything is? Do we as an organization put everything in the same place? So if you're told, we're going to do an offering, get going. Is there someone say, yep, we've got this loosely all together, I know where to look, or like, oh gosh, I need to survey 15 people, and guess what? Not all of them know about this, so maybe I can't ask, and the same way. So it's really knowing where things are. Ideally, it's also in a separate data room as well, right? I think the structuring of that is very helpful, but even just taking one step back, right? Like, what are your overall processes to know where everything is?
That's great advice. Claudia, I'm going to pull in your expertise on this question. So there's a question here. What can we do as fund managers to better prepare our portfolio companies for IPOs? They're looking for liquidity events. You know both sides of the table. So any advice there for fund managers?
Well, I think, in terms of the IPO and M&A, just like what Francois said, you need to be prepared for the exit period, right? Because you don't know what the market is like one way or the other. You need to evaluate alternative at the same time concurrently as you move forward. And meet with your CEO, look at the maturity of the company, the milestone that they have achieved. If the opportunity is there, when it comes to M&A, I think you as an investor really need to help the company engage with the potential M&A buyers very early, just like Francois said. The earlier the better for the IPO process, the earlier the better, even to have a M&A roadmap as well. Who are the strategic? Who are the potential buyer? I mean, otherwise you're just going to a fire sale when you're ready to go and you're sort of a go shop and everybody's looking at your valuation and say, no, I can get this at a fraction of that. So you want to develop that kind of strategic synergy on both ends. And by the way, also help a lot with you to look at those strategic relationship when you're preparing for IPO, because that also affects your valuation significantly, the constant, channel to market relationship that you have, OEM relationship. So as an investor, always go through the scenario planning for these liquidity events that are even when you think it's still way out there, but it is much more of a journey than a transaction for you.
Amazing. Francois, you touched a little bit on this, but we have a question from Cervantes. What's the best, when is the best to discuss the employee stock option plan during the IPO preparation process?
Yes, I'm glad that question came out. So it's a multifaceted answer to this question. So obviously, one of the things we talked about very early on was one of the benefits, and Claudia and Liana mentioned this, one of the benefits of like going out and being a public company is you create this liquidity event for your employees that, if we've seen it, some companies, if they don't go out, and Claudia mentioned it, you don't have that liquidity, you've got employees that have got a lot of paper, but no potential way of benefiting from that paper. So one of the things that I think is important is there is a lot of folks within companies who believe that the moment the company goes public, that they suddenly will have all this money, right? And they go out, and we've seen this, and they go out and they'll buy stuff, right? Well, there's a whole education process that needs to occur to explain to people what it actually means to be a public company. They may have stock options that are ISOs, which are incentive stock options or non-qualifying stock options, or they may have RSUs or whatever else. There's various different forms of options that they will have received. And that depends on where the company is and the size of the company. But then there's going to be an event when the company goes public. So firstly, you've got to explain to people, what does this mean from a taxation standpoint, right? That is incredibly important because most employees do not understand what that means. So having some form of pre-IPO education that is put on for them to understand how this is going to impact them from a tax standpoint, very important. And I've seen that being presented by the lawyers, by the bankers, by the audit firms. It's a mix of folks, but doing that is important because what you cannot have is disgruntled employees because they have this tax hit, for want of a better term, that they were not aware of. Now, that's just one part of the story. The second part of the story, coming back to the folks who think they've suddenly got a massive amount of liquidity and can go and buy something. Well, Liana can probably jump in and give the specific details, but there are lockup windows and then there are blackout windows. So a company goes public, there's a lockup window in which no employees can actually sell. And so you can't actually get the money, right? And which is an interesting point because you may have a tax impact on day one when the company goes public, and then the company can work out how to essentially fund that tax. And there's different ways that can occur, but then you still don't have the money. And then you wait the 6 months and then potentially you have the optionality of having the liquidity and doing something with your stock. However, you may then hit a blackout window. And a blackout window is then because you're filing your next quarter or your annual, your 10K, your 10Q, your 10K. And then the question is who gets impacted by that blackout window? And in new companies that have just gone public, it may be decided that the availability and the pervasiveness of information is such that everybody in the company has enough data and details that they all get captured in the blackout window. So in some of my pasts, and with some of my companies in the past, you've had the 6 month blackout, 6 month lockout where you can't sell. And then just as you're about to go, you hit the blackout window because you're about to file. And that can be another 60 days or something like that, 45 to 60 days. And then depending on who you are within the company, there may be further restrictions. And so educating everybody on all of that, tax and liquidity, super critical, because otherwise you could end up with very disgruntled employees. Liana, Claudia, would you add anything to that?
I agree with all of that.
Yeah, yes, it's an aspect that many times people are just not aware of that. They think they celebrate this incredible liquidity event, and everything is free after that, and don't understand the whole structure of it.
Yeah. So Colin, it really just comes down to as much education as possible.
Yeah. Super valuable inputs. All right, we've got time for a couple more questions, but we've got a break coming up and another panel, so we're rolling right along. Okay, so just to the group, whoever wants to jump on this one, what are your thoughts on pros and cons of going IPO versus direct listing?
Why don't I take that one? So an IPO is a capital raise event, right, at the end of the day. And I think we often forget about that component of it because there's so much else going on. Direct listings are not traditionally, right? And there are rules tried to say, okay, we'll build a capital raise component into this, but they actually have not been fully vetted yet. So I will tell you, if you want to pursue that, you will be the front runner, which means you're going to be vetting these rules actively. So what that means is a direct listing is you are creating a public market for your existing shares, but you're not selling any new shares, right? And so the entire optics of the offering change. So in an IPO, you have banks who are underwriters. You're only selling, remember, 10%, and that's your public float. Everyone else is locked up, as Francois said, for 6 months, right? And then over time, other holders get the right to then sell in this public market. Direct listing, you don't have underwriters who are controlling the stock and helping you set the pricing and doing all that discovery. You do have financial advisors, but their role is a little bit different. And you're actually registering all the existing shares all at once and then hoping that people are interested in buying all of those shares. So the marketing of it is slightly different. The way you think about public float is very different. But kind of to boil it down to its very core, fundamentally, it's do you need a capital raise, or are you really just solving for stockholders, employees needing liquidity, and you don't need the money, in which case, right, that direct listing is going to look a little bit more attractive. We've seen a number of them, right? I think there've been sort of 2 in the history of time, and then there was this big wave of a bunch of them. I think brand names tend to do better, right? Direct listings tend to attract more retail investors, and you don't have these underwriters to stabilize. So you want to be kind of clear-eyed about who your market is, who your target audience is from an investor perspective, and that's going to feed in a lot to whether or not that's going to make sense for you as well.
Awesome, thank you,
Yeah, the only other thing I would add from an operational standpoint to Liana's comment is if you're going to do a direct listing, make sure you have a very good, strong stock admin person, because that's what they're doing. They become the person who's doing all the transactions on the buying and the selling of the stock.
Amazing. All right, well, we are at time, but we call it a boot camp, but wow, this panel really was in all definitions of the word a boot camp. So thank you so much, Francois, Liana, and Claudia. What an amazing discussion. So many great insights shared. And thank you again for the time.
Thanks,
All right.
Bye, everybody.
Bye-bye. All right, for those of you still on, we're going to transition into a quick break before our next panel on executing your IPO. So please take a quick moment to refill your coffee cups, take a break, and we will return very shortly. See you in a second. All right, all right. Welcome back. All right, we're going to transition into our next panel, executing your IPO. Before we jump into that panel, though, I've got a quick poll that I'm going to launch to let our speakers know what side of the IPO process are you looking to learn about today? So the next 18 to 12 or 12 to 18 months, are you planning on starting the IPO process? Not quite yet. Headed in that direction, yes, but not within that time frame. Let us know. This will help fuel our upcoming panelists. Looks like there's a pretty good mix. I'm going to let this roll for just another moment or so. Thank you for voting. All righty. So I'm going to end this poll. Share those results. Looks like decent amount are headed in that direction. Many are just not within that time frame, and then a bunch more here to learn and not quite yet. So thank you for participating in that poll. So without any further delay, please join me in giving a warm welcome to our special guest for our next panel. We've got our moderator, who's Dan Angus, Managing Director at Nasdaq. We've got Gordon Graft, who's a partner at Wilson Sonsini. We've got Leslie Prang, who's a partner at Class V Group. We've got Marissa Johnson, who's a managing director at KPMG, and Matt Skarupa, CFO at Duolingo. Welcome, everyone. So looking forward to this conversation. Dan, over to you.
Thank you, Colin. And hello, everyone. Very excited that you all could join us here today. And we have an esteemed panel that has a wealth of experience in the IPO markets and their own personal experiences, and then helping other companies, much like yourselves, scale this mountain. Before we jump into the questions, I did want to just share a little bit of more background on myself, as well as give our panelists the opportunity to as well. Again, I'm Dan Angus. I'm a senior managing director at Nasdaq that engages private companies in helping them evaluate the Nasdaq exchange as a potential listing venue when that becomes, and if that becomes, a strategic exit option for companies. Understanding that a lot of companies take many years in order to gestate, we like to engage beforehand and find ways of supporting them, and look forward to engaging with you all. Gordon, maybe I can turn it over to you for your background.
Yeah, absolutely. Thanks for having me on. I'm Gordon Graft. I am a partner at Wilson Sonsini based out of San Francisco. My practice primarily works with technology companies, usually starting to work with them as they're in this, 12 to 18 months before IPO, starting to think about it phase, helping them prepare for an IPO process, working with them through the IPO, and then doing public company work on the other side of that on transactions, governance, etc.
Excellent. Thank you, Gordon. And then Leslie, over to you.
Thanks. I'm Leslie Frang. I'm a partner at Class 5 Group. Class 5 Group is a consulting firm. Basically, we work with companies that are planning to go through the IPO process. We do IPO readiness work, project management, capital markets advisory, and then we also help set up and execute investor relations strategies.
Wonderful. Thank you for joining, Leslie. Marissa, over to you.
Yes, thank you, Dan. As we mentioned, my name is Marissa Johnson. I'm a managing director, also based in San Francisco with KPMG in our audit practice. My career has focused on working with startup technology companies through their IPO process and into their first few years of being a public company. So excited to get the chance to talk with everyone today.
Excellent, excellent. And last but certainly not least, Matt, thank you for joining. Can you share your background?
Yeah, happy to be here with you all. I am Matt Skarupa. I'm the CFO at Duolingo. I joined Duolingo almost 5 years ago to help them prepare for an IPO, and we went public with the help of Leslie and on the Nasdaq in July of 2021.
Excellent. A crowded cohort in 2021, but Duolingo definitely stood out and still is performing and outperforming today. So very excited to have you on the exchange. Sticking with you, Matt, I'd really, love to get into the concept of what you had gathered about the IPO process prior to becoming the CFO of Duolingo, and then, what you thought about it when going through the process. So, how did your experiences at Goldman, KKR, and Bain influence how you eventually would run the process? And were there any surprises along the way when you actually started?
Sure. Well, Dan, there was a chat. Can you hear me okay?
I can.
Okay, great. Well, then I'll keep going as if everyone else can too, and we'll just see if that was just a one-off. So I think I had an outside-in view of what IPOs were like, and I had been around certain processes in the past, and the thing that I brought to bear was I think I have a natural detail enthusiasm, which is important to an IPO process. There are less kind ways to phrase that predilection, but I prefer detail enthusiast. So,
Sure.
When folks would tell me that there was a checklist type process and all of that, I thought that part I would understand. I think the things I knew we had to do is that getting ready to go public is getting ready to be public. And so you have to harden all of your processes. And I knew that was going to be a lot of work. And I knew enough about what I didn't know to ask for help. So you're going to need to engage various accounting firms like Marissa's firm to help you not only upgrade your audits, which is obvious, but you're going to have to help create that risk matrix, harden your controls, all of those things. You're going to get your systems up to speed and all of that. So there's like a big bolus of just technical type work that has to go on. That's one type of work. I think the work that was less obvious to me coming in from an outsider that I now know is really important is the storytelling element. I knew there was going to be a value creation story that we were going to tell for investors in our IPO, but creating that process collaboratively with not only your external advisors, but internally is a really important part. And then, finally, the last thing I would say that I think is not like the other, and I don't hear other people talk about it, so I might be wrong, so you all should take it with a grain of salt. I think the IPO is a unique experience and opportunity where everyone at the company is gathered around a really exciting goal. There are very few companies, I think, that aren't excited about the process. And you can use that to really drive home the third element, strategic alignment amongst your board, amongst your C-suite, but broadly across the company as well. And I think that is something that I did not expect to be so powerful as we went through it. Was, we had a strategy and it was a good one, but this helped us refine it, get further alignment, figure out where folks were telling slightly nuanced stories and get everyone on the same page. So those are the three things that I would highlight based on my experience.
That's excellent. And just a quick follow-up to that cohesion that you mentioned, was there anything intentional that you did to produce that, or was that a byproduct of the process itself?
Well, I think it's both. I think, when, getting a whole company staring at the same thing and getting them all excited about something, if you can manufacture that in any way, I'd recommend people do it. That's an amazing, amazing thing. We do it with our mission at Duolingo, and, we try to continue it. But the IPO, I just think, has that gravity to it, where everyone is drawn to it. And then I do think you have to be super intentional about it. We have a very transparent culture. And so we worked very closely with, our lawyers. Gordon can provide some commentary on this around getting, everyone comfortable with sharing basically as much as we felt was, legally acceptable with our company as we went through it. And bringing them along is, there are certain things you can't share, but bring them along as much as you can, as transparently as you can in the process, was another way to kind of really take advantage of that gravity and that unique goal that is an IPO.
Definitely. And Leslie, you were right there throughout the entire process. And I'm curious, given not only the Duolingo success, but you've been now, I think, at Class V for about 11 years or so. You've had an excellent track record with IPOs. What does a good IPO readiness process look like from your perspective? And I'd love you to comment on any of what Matt just shared to give your own perspective on, his insights.
Well, a couple things. Number one, I can attest to Matt's detail enthusiasm, having worked with him very closely for, over 18 months on the IPO process. And that's an amazing asset in your CFO, to really get into the weeds and, understand everything that's going on. It's critically important. But what I think makes a good IPO process, and I think leads to the outcome that Matt talked about, is is understanding that being IPO ready is a cross-organizational effort. Some companies have a perception that it's a legal and accounting exercise only, and don't want to distract people across the company. But then, and a lot of the work is in legal and accounting, and you need great advisors like Marissa and Gordon to help you, because it is a huge lift in those areas. But if you don't pull the rest of the organization along with you, you don't get the benefit of that strategic alignment and cross our organizational hardening of all your processes and your strategy and your story and all of the really good things that Matt talked about and the benefits that Duolingo got. And so I think understanding that from the beginning and putting that in place as Matt did, I think was really one of the core kernels of success, I think, in their process.
Excellent, excellent. And so when you're thinking about your role in relation to the companies that you support, we've worked together periodically, and I've always seen you, at least the executives that you work with, viewing you as a peer, viewing you as a trusted advisor. And so that probably entails telling hard truths at times. I'd love you to share, for just coaching wise for others that have to do the same, what are some of the points in the process where you might need to course correct? How do you deliver those messages? Any guidance there?
Matt, that's just not my nature to be direct. I'm kidding. But no, I mean, the truth of the matter is that when companies are doing big transactions, there are a lot of competing agendas, and there are a lot of yes men, and there's a lot of scope creep, and I could go on. At Class 5, I mean, we've been at this for 13 years. We founded the company to work with founder-led companies and keep them in the driver's seat, make them successful, keep them in control of their destiny, do whatever it takes to make them look like rock stars and succeed. That is our entire mission. And so sometimes that requires, making them, understand in private what could happen if things happen in public, right? And so we're very direct, and I think we develop a level of trust with the companies that we work with, because they see us over and over again always representing their best interests, even when it's not in our best interest to do so, or in anyone else's. So I don't know if that answers your question, but we love the companies we work with. We are absolutely in awe of the founders and the companies they build and the people that are there building it with them. And so, our whole mission is just to help that group step up and do the one thing they maybe haven't done before, which is prepare a company to be public and then take it public. And we love seeing them succeed on the public stage. That is the greatest, the greatest thing that is the happiness that we get out of Class 5 group, is enjoying seeing all those companies do so well. So,
well, I hope there's more to come and more happiness in 2025, Leslie.
Feels like there's going to be a little more happiness, but
I hope so. I hope so.
I wanted to take it just a second, because I work closely with Leslie, and the trusted advisor part. I'm biased. Leslie is great, but she became a trusted advisor, and that means when you're a trusted advisor, you can tell someone the truth, whether it's hard or not. And that's where it comes through to me. And just to echo or kind of really just triple underline something she said, there are just a lot of different incentives in an IPO process. And it is nice having a river guide, which is what I call Leslie, who's kind of in your foxhole, who's seeing the world your way and being on your side. Because there are plenty of people who, they're not out to get you, but they are seeing things differently, and their incentives are not perfectly aligned. So I think it's great to have
excellent. Well, appreciate that, Matt. Speaking of really important advisors, Gordon and Marissa, maybe Gordon, will start with you. I mean, Wilson Sonsini, we don't need to tell the audience, it has a rich history of IPO work ranging from Netscape many years ago to most recently Ibotta and their strong offering earlier this year. I'd love for you just to give a little bit more of a framework for our audience and sharing who are the, outside of CEO, CFO, what are the less heralded key people in the IPO process that our audience should probably take into consideration as they look towards it?
Yeah, I mean, as I think about this, there's sort of three key teams that I think of, and it all comes back to the same notion that Max started with of storytelling. And so if you start with someone like Max's team, that's going to be, how does the finance team think about forecasting? How does the finance team think about key metrics in measuring the success of the business? And how do you translate?
Hey, Gordon, I'm sorry. You know what? You're coming. Hey, Gordon, I'm sorry. You're coming in a little choppy. If it's okay, maybe you can check on your internet connection, and then we'll move on to Marissa just for a moment. We'll come right back to you once we get the tech issues figured out. Marissa, if it's okay, maybe we can move over to you and just talking about accounting principles and structure of reporting and just anything else that you think would be helpful in relation to understanding the steps and the reporting elements that you should probably consider during an IPO.
Yeah, absolutely. After what everyone else has said, I'm sure that getting into the nitty-gritty of the accounting is exactly what everyone wants to hear now. Very exciting. But I'll cover it quickly. I am seeing through the chat. Gordon wasn't coming through choppy for me either. So hopefully when he comes back, he'll be good to go. But I think just to highlight, I think there's some specific disclosures that are required for public companies that are not required for private companies, which range from things like EPS and segments to expanded disclosures in the revenue section, which is good for companies to be aware of just because some of those things would require additional data, reporting, or things that they may not have been considering or calculating historically. And so having the processes and information in place. There is also, of course, increased focus on equity awards and the pricing on how companies have historically, compensated their executives, board members, employees through equity. And I think Matt mentioned this also. I think one of the big important things beyond those very detailed pieces is making sure that the company has the processes in place to be comfortable with the numbers in the right amount of time. And so building out those processes and controls, not just around those GAAP financial numbers, but also any of the other metrics that the company is reporting, making sure that you're really comfortable, that you're able to get those numbers reliably, consistently, and timely, such that you can meet the filing requirements throughout the IPO process and then beyond that. So echoing Matt absolutely on the preparation for the IPO is really the preparation for being a public company after that IPO process. And so having these processes in place and being able to be practiced and ready to go is really important.
Appreciate that, Marissa. Thank you. And Gordon, I owe you a beer afterwards. This apparently was all on my end, so I'm sorry about that. It's going to be coming in the mail. Maybe we can go back to what you were saying, and I apologize, but just to refresh, key responsibilities of the less heralded individuals in the IPO process. Any thoughts on that?
Yeah, absolutely. I think from the finance side, as you think about telling the story, it's really important to have strong FP&A teams and other IR-focused teams that can translate what's happening in the business quarter to quarter into a narrative that will make sense to investors. How do you tell people what's going to impact the company on a quarter to quarter basis? from the accounting side, I think Marissa just did a tremendous job speaking about the amount of work that it takes to do the uplift to become a public company and all the steps that those teams will go through. And then from the legal side, it's similarly a whole new world out there with SEC reporting requirements and stock exchange governance requirements. And beyond that, as you tell the story of the business in a strict liability document, you really have to pull in from the expertise of all the different lawyers that a company might have, whether it's employment folks or regulatory folks or product counsel, and really take their knowledge and deep insights into the company and translate that into something that's going to protect the company, but also still allow someone like Matt to go out and do his job and sell the stock and tell the story in a really compelling way. So
Excellent.
It's a really collaborative, big team effort.
Certainly. And then Matt, when we think about what made Duolingo's IPO a success, I mean, if you look at 2024, 60% of the IPOs that went out and outperformed had a cornerstone investor or strategic partner that served as the bedrock. That's just one example of maybe a best practice here that we're seeing develop. When you were going through the process, were there anything that jumped out at you as a best practice, things that made the IPO even more especially successful?
Yes, there definitely were. By the way, Dan, I'm going to ask again. Can you hear? I changed my headphone. Better, louder?
I can hear you. I hope
Great.
it sounds good to me. Anyone
right.
else chime in?
Yeah, well, the chat will help. I mean, I think the first thing, I mean, to go back to first principles, right? Like the IPO preparation is preparation to be a public company, which is preparation to be a durable and long-lasting company, right? That's why you go public. You go public to access capital markets, which is, the US capital markets, unbiased, are like one of the best inventions in the history of mankind. And you're doing that to access those. And that's why you do it. But you also want to be a durable business that's long-lived in the public markets. And so the question you're asking about having a good IPO is really a question around how do you set up your business to be a great business? How do you make it durable? And to me, durable is ultimately going to be measured, based on your free cash flow per share, because I'm a finance guy, but there's a bunch of other ways to measure it. But you're going to pick your metric and say, like, this is how we think in 10, 20, 50 years will be measured as a durable business. And do we have a business model that will lead to that? And can we be innovative along that path? I was very lucky, Duolingo is an incredible business with incredible founders. And so the IPO storytelling was, I liked what Gordon said around translating. We have this story we tell ourselves internally about all of the great things we're going to do, the growth we're going to go achieve, and the profitability, et cetera. And you need to translate that for the public markets. And it's a bit different than the private markets. I think the public market investors are incredibly sophisticated and smart. And they don't, they can trade your stock. They can sell if they want to. They can short you. They can do a whole bunch of things that maybe don't happen as often in the private markets. And so it's really important to distill down to the core essence that translated story. It's not enough just to have a great story. It has to be a very pithy and understandable story. But again, it all starts with just being laser focused on building that incredible business in the first place.
You mentioned a question that was going to be coming up regardless was a question around private versus public investors. And so I'd love to get your brief take on just the core differences between the private investors versus public market, that are actually practical that you think the audience should know about.
Yeah, I mean, there definitely are a ton of differences that we could list. I'm trying to get to the essence of it. I think the biggest difference that I would call out is that in the private markets, you're getting an investment from a venture capital firm or private equity firm, growth equity firm, and they are doing an extraordinary amount of diligence, and then they're along for the ride, and they're taking a very active approach where even if they're not helping you manage the business or create value, they're very involved and they're very up to speed and in depth. They might even be in the boardroom as a director or an observer, and that's pretty much your experience with them. And they're very high context conversations, and so they can be a little bit more shorthand or whatnot. In the public market,
it just goes back to that pithiness. I think a lot of public market investors spend, several hours with a company a quarter versus several hours a week or a month. So I think it's really one of just time span. Now, the public market investors are, sophisticated, and a lot of them spend a ton of time on your companies, but there's plenty of those that you'll meet with very quickly. Again, you just need to be able to address their core questions and their core concerns, because they will all have some concern, as quickly and directly as possible, which I think in the private markets you have just more leeway with that relationship.
Excellent. That's very helpful. Thank you. And Leslie, turning over to you, when you think about the investor landscape, the bankers that I've spoken to, for example, currently now recommend that companies that are looking to do investor engagement are looking around between 60 to 70 meetings, inclusive of, let's say, a roadshow, which is a far cry from the 30 to, let's say, 40 that happened on average pre-COVID. What do you think about that number? And what do you think about the concept of scarcity, in relation to meeting with investors and creating a brand around, the company? Do you have any guidance on how frequently or infrequently you should meet?
Pre-IPO, we do a target investor analysis. We try and identify the top 20 to 25 investors that we want to spend time with. And we try and meet with them at least twice. We want to meet in their offices if we can, because that's where you get portfolio managers versus analysts that are really out at conferences. And also the conferences are very short format, so they're more like speed dating versus really getting to know each other. With respect to scarcity, a little bit of it depends on the company. There is some value to educating the broader market on the company. But the real success of the IPO is, at the end of the day, is going to turn on, the top, 25 long-term investors that own comparable companies, have owned companies like this in the past, have a track record of building positions and holding them for a long period of time, and that have multiple pockets of money that can invest in the company, right? So they're multi-product mutual fund complexes like the Capital Groups, the Fidelities of the world, the T. Rowe Prices, et cetera, the JP Morgan Asset Managements. Those are the ones that we spend a lot of time focusing on and developing relationships early on. And I wasn't trying to exclude anybody. There's wonderful investors I didn't mention, but those were just ones that came to mind quickly. So to your question, you also have to keep in mind, though, that private companies, everybody wants to take a private company on the road because they're not subject to FD, and investors might learn something interesting about a public market investment that gives them a little bit of an edge. We don't like that very much. We like our private companies to meet with investors that are actually interested in learning their story. And so we want to make sure that our companies are very buttoned up and prepared, and that they're meeting with the right investors. So we run that process pretty tightly.
There's a really good kernel of wisdom. Multiple, but one which is go in person as opposed to Zoom. I really appreciate that. And it leads me to ask, outside of the LAs, San Franciscos, New Yorks, Bostons, there are other geographic areas that have very good investors that are very thoughtful. How do you think about the second to third tier geographies? How often do you direct your clients to them? What should the audience consider there?
Do you mean once you're public or
private, or when you're public from an IR standpoint?
Again, if you're private, don't go out every day, and you create an expectation as a private company if you start attending all of these private company conferences and running around and meeting with public investors that you're, going to be going public in the next year or so, or certainly not more than 18 months. And so if you do too much of that and you carry on with that for, years at a time, there a perception starts to build that why didn't they go? What's wrong with this company, right? So we don't encourage our companies to go out and meet as private companies too early. We want to have 2-3 meetings with at most with the top investors. We want it to be a deep dive in their office, an hour and a half, to the extent that we can do that. With respect to geographies, most companies will go in person to Boston, New York, Mid-Atlantic, and the West Coast, but you fly right over the Midwest. And to your point, there are some wonderful long-only investors that may not be the largest mutual fund complexes in the world, but are great to spend time with as well. There are also some, good investors in Europe and in Canada. Typically, those are covered with video, though, because you also don't want to exhaust the management team. They have a business to run, and but yeah, hopefully that answers your question.
Oh, it does, and thank you. And it's a very nice segue into thoughts from you, Gordon, about how in those investor meetings there's a concept that the words and the numbers on the numbers on the deck need to tie back to the words that the executives are saying. And so maybe you can just share from your experience, like some potential risks or challenges related to compliance in either of those scenarios of discussing things pre and post IPO, or maybe other areas of risk that you think the audience should be aware of.
Yeah, as you think about the roadshow, I think the important concept is anything material that management is going to want to say needs to be covered in the registration statement. And so when you work with sophisticated advisors, they will help you navigate that thoughtfully and carefully and give you the rein that you need as a management team to tell your story in your words the way you want to. And also have a registration statement you can stand behind that's not going to create a whole bunch of unnecessary legal risk. And so that's a balance that you do throughout the whole transaction, but it always needs to be done with the North Star being, we want to have a successful offering. We want to set the management team up for success, and we want to be able to let them tell their story in their words, emphasizing the points that really let you understand the business. Obviously, from a compliance perspective, there's a number of different areas that come up in the IPO, because as you think about it, if you're going public, it means you're a high growth company. It means you might be challenging new industries. It means you might be breaking a market that hasn't happened or been disrupted like this before. And so what you're doing often in the same way you're doing it on the accounting side, you're scaling out your legal team. You're scaling out the way you think about emerging complex risks. And so taking that, making sure you've got the right processes in place from that perspective, making sure you're developing sound governance practices, both for the, SEC stock exchange governance side, but also for the just good company, good governance, privacy, and other areas practices. It takes a mountain of a team. It takes so many different people in so many different areas all weighing in, but when it works collaboratively and cohesively, you end up with what's a very strong company. And especially in this IPO process where you have one outcome that you're all marching towards, it's this great unifier, and it gives everyone a great end goal to focus on.
Yeah. So, but you bring up an interesting point that, when do you begin with this important area? I mean, the IPO process could be about 12 to 18 months, let's say. When would you recommend that management and the rest of the team start flexing the compliance muscles? They'll start building out that infrastructure. Do you have any thoughts on that?
Yeah, from my perspective, there's sort of two categories here. And one is just building a great company. And I think that's something you should be doing from day one. You should be focusing on sound privacy practices. If you're dealing with AI, you should make sure you are on top of it and you've got good governance structures around that. Whatever areas your company is pushing on, you want to make sure that you've got a great framework, a great base, and you're being thoughtful about the regulatory issues that apply to your company. Then there's sort of the, hey, as you go public, you're going to be required to have, fully independent committees and think about board composition and dual class stock structures if you want that, and all of those. And that's something that usually can wait until you get started on an IPO process in proper. You might have some initial thoughts about it, but there's not a lot of value add to that as you're running the day-to-day private company. It really starts to become a lot more meaningful as you're getting closer to that lift. So the stuff that's just building a great company, do that now, because that's going to benefit you. That's not going to harm your company in any way. The stuff that's really tied to the IPO, take your time on that.
Makes sense. Makes sense. And Marissa, like Gordon said, one of the areas where companies might have issues and might result in a stalled IPO is due to risk and compliance. But I'm curious if there's been anything else in your experience where, you can point to reasons or events that have stalled other IPOs that you've worked on as sort of a cautionary tale for the audience members who are going to go through the process.
Yeah, certainly. And I think to follow into Gordon's answer here, I've definitely seen IPOs both ways, where ones happen in like 6 months, and we all are scrambling to kind of get to the end, and ones where companies are really prepared. I think in the past few years, we've absolutely seen a lot of companies' IPOs stall, not necessarily due to them, but just as we all know, the markets have been not as advantageous to kind of move. So I think all IPOs are focused on when management and the company is ready to go, are best positioned with their financials, their growth. As Gordon mentioned, when a company goes through an IPO, you're expecting high growth. And so I think companies are wanting to make sure that they're ready to be there. We're obviously also seeing a lot of movement and focus on profitability, and having a path toward that, and being able to tell that story. So from a just story, financial numbers perspective, companies need to make sure they're ready for that and align that with when the market is ready. I had one who was ready to flip their S1 to public in early 2022. And the night before the filing, the board said, nope, we're not doing it right now, because of the way the markets were going. They did eventually have a very successful IPO, but it took a little bit longer as we waited for the markets to come through. And I think the silver lining to all of that, as I think what everyone has kind of echoed, is that that company had a couple more years to make sure they were fully ready to be a public company, and they were. And so taking that extra time, making sure the compliance is in place, the procedures and processes are in place, so the company is fully ready to hit the ground running once they're a public company. Is really important.
Excellent. You said something very interesting, which was that pendulum swing between profitability and growth and how we've seen it move. Granted, I completely agree that profitability and the pathway there is important, but I'm curious if you've gotten any indication from either companies or investors or other market participants that maybe we're swinging a little bit back to growth a bit, or there's been a softening of that narrative, or do you believe that it's as strict as it was when it popped up first in 2022 and 23? I'm
going to let everyone else weigh in on this one also, so don't leave it to me.
I'll hit it real quick, Dan.
And I can follow on.
I think I think the pendulum has swung back a little bit. I mean, I don't think it's we're in the heydays of growth at any price. We'll figure unit economics out later. I mean, that's definitely not a flag you want to fly out on the IPO field, but I would say that if your unit economics are really good and getting better, there is definitely appetite for spending into that at this point. I also want to say that I think the IPO market is a lot better than people think. And when I say people think, I would say maybe than the bankers let on, because the bankers like to do big IPOs. They make they make more money doing big IPOs. So they want companies to reach scale. They also make more money selling companies than they do taking them public. So I don't think there's been a lot of push on, and I also think, I don't think that companies have been focused on getting ready for IPO. To both Marissa and Gordon's point, they both talked about companies that they've worked with that find they're not ready after they're already heading towards IPO. And I think the reason that happens is that they're not actually getting ready. They're looking, again, I'm going to go back to my thing of they're looking at this as maybe a legal and accounting exercise. And the long polls to get ready can be in any part of the organization. It can be corporate structure. It can be tax structure. It can be a data problem. It can be a security cyber problem. It can be a lot of different things. And if you don't actually start like 2 years in advance and do a wholesome flyover and think about, put together a plan to get a company ready, you're going to find yourself in that position that Marissa talked about, where you're thinking you're going to go public and all of a sudden you're not. Like, we call our work plans swim lanes, because if you're not all swimming at the same speed, you're not going to get to an IPO at the same time. You're only as fast as the person that's, on the other side of the pool. And so I think the important point to take from that is it takes at least 2 years. You can maybe do it hair on fire in 18 months to get ready for an IPO. And it's a cross-functional, effort. And you really have to identify your long poles and be working on all of that stuff across the organization. And to Gordon's point, there's a lot of stuff that has to do with the transaction that you don't need to do and spend money on. But all the stuff that you're going to do to get the company ready to go public, the systems work, the organizational work, the hardening of the processes, the forecasting, are things that make the company better and stronger, but it takes time. And anyways, that's that would be my response for that. And no, if your unit economics are amazing, you don't have to be profitable right now, but you do need a roadmap to profitability.
Got it. And just a quick follow on to that, like a roadmap, let's say go public on day one. How many days later or months or quarters later would you recommend that roadmap leads to? It
depends on the strength of the unit economics and how excited people are about the company. But I would say within the year of IPO, within 4 quarters of IPO, I think people would like to see you getting there. But that I don't think there's a specific rule.
Got it.
Matt, do you have a point of view on that? You're so far past that now that you're probably not thinking a lot about that. But
no, I think you're right. But I do think, when you're running the IPO process, Leslie, I think you're on to, in general, look, every business is different, every IPO is different, but in general, within the 4 quarters post IPO, people are looking at your trends and they're going to form a pretty strong opinion based on that, both in growth and profitability, in those next 4 quarters.
Makes sense. And Matt, Leslie was talking about long polls in the tent. I think one of them happens to be the governance structure, the board members and the independents that you bring on and how you evaluate them, how you get to know them, and that process. Can you share with everyone, what you did and what you would recommend?
Yeah, I mean, a couple things. The founder-led business that we took public, I think, had a bunch of advantages, but we had the swim lane element that Leslie was just talking about, I don't think can be understated. The board and governance is one of those lanes. Mm-hmm. And if you don't have people at the top, either the board or in my case, the board and the founders who have locked arms, understand that there's going to be a lot of work to do, there's going to be expense, and there's going to be opportunity cost. That's where I think you might get into some trouble. And so for me, my founders were like, look, this is priority 0. And so we are going to take time away from running the business, which we love doing and gives us energy and makes us feel good and is why we're doing all of this, to interview a bunch of people that we want to be with for 10 years on the board. And if your leadership or your board or your founders view that as a task either to outsource or that is just not worth doing, that would be something I would have a conversation with about, because again, I was very lucky. They understood that, but it is those relationships, board relationships, and I don't know what the psychology is. I'm not a psychologist, but they're oddly intimate, right? You're friends with these folks, and so I think that it's a relationship game. And so if you have a CEO or a chair, one of the conversations to have is like, you're going to have to take some real time to spend with people. These aren't job interviews where you sit with an hour and say, what's your skill set? That's important. Of course, it's important. You gotta get the right skills on there, but it's a relationship game. These are intimate relationships that are going to be long lived. And so they have to put that on the swim lane chart and really commit to it.
Yeah, and I just a quick follow on to that. In a transaction, as important as an IPO, you're going to have periods where heated discussions might happen, or you might see a challenge coming down the pike. Like, I know it's a relationship game and we all can manage relationships, but do you have any guidance on how to approach maybe new board members, maybe existing, with hard truths or difficult discussions?
Leslie, that was a question for you, wasn't it? No, I'm just kidding.
No, I can help with that, but
Yeah,
you
no, well, you can. So I honestly, this is the point around having advisors that you like and trust around the table, especially for those board conversations. And I'm speaking as a CFO who's done precisely and exactly one IPO, right? So,
Sure.
there's some caveats you guys should all adjust my commentary with, but this was my point, and I think I made it rather obliquely earlier, which is that there's just a lot of incentives. You have new board members who have incentives, existing board members who have incentives, executives who have incentives, and then you've got the advisors who have their own incentives. And I think having a set of advisors that you really trust and respect, who can help you manage through some of that, is really important. Leslie helped me manage through this. I think bankers can be great. We had great lawyers, so Gordon can. And then there are times, believe it or not, and I'm sure Marissa can attest to this, where you're going to have your accountants come to your board and talk about why some of the things might not be as quick as, why the SEC might, be this timeline or that. And so I think it's a whole of advisor approach to those conversations, besides just the relationships. And that's why, again, I just want to underline, that's why those relationships are so important. Like the advisor relationship.
The one thing I would say is bring them along for the journey and control the process, because it is every board has different personalities, and every company has sort of a different culture and things like that. And a lot of people want access to your board when a company is going through transactions, and it can turn into a circus. So you want to keep and it's not your board's fault. It's at all. You want to keep close control over, you want to bring them along on the journey you're on. You want them to have all the information they need to have, and you want to get the best out of them in the process. But it's not a free for all. You don't want everybody in there one-offs every day. It needs to be, I think, a curated process by the founder and CFO. And Duolingo had an amazing board. They had a lot of experience, and and Matt did a great job. But that would be my advice: is kind of keep control, curate it, bring them along for the journey.
Oh, excellent. Thank you for that, Leslie. And I think it's a good place to get to our key takeaways. And so each of you, if you wouldn't mind just sharing, to Matt's point, a pithy sentence or two on the primary takeaway that you would suggest our audience to bring away looking to 2025, be very much appreciative. And Marissa, maybe we can start with you.
Great. I'm happy to go first on this one. I think we've all kind of said it, and it really comes down to making sure that your company is ready to be a public company. So having those processes in place, the corporate governance, I'm going to cover everything. Everyone else can say ditto if you want. The board representation, the story, and the comfort over the metrics that you're going to be sharing on a regular basis is key to making sure that the company is ready to go public and then continue to operate successfully as a public company with the scrutiny of the public markets.
You bet. I mean, I'm glad that you went first, Marissa. You crushed it. Thank you.
Thank you.
Gordon, over to you, my friend.
Yeah, I will build on that and say, team, because look, think about all the things that were just mentioned. There are so many different elements and so many different challenges involved in coming up with the right internal teams, the right board representation, the right external teams of advisors. You're going to be spending months, if not years, with this working group. And so it is essential that you find the right people to partner with, and essential that you develop those trusted relationships so you can navigate the good and the bad together to have a successful IPO.
Excellent. Thanks, Gordon. Leslie, what's your takeaway?
I would say start early. Some people to hesitate and start right. I'm not saying start drafting. I'm saying start preparing the company. And actually don't start drafting. That save that till later. But actually start preparing the company to be a public company, not to do an IPO. Because all the work that you're going to do is, I've never worked with a company, whether they at the end of the day went public or not, that didn't get value out of going through the process. Like Matt said when we started, aligning the whole organization around, the goal of just operating like a public company, building all that muscle. It takes time. It's like working with a trainer. It's like training for a marathon. And so I would say start early and make sure that you have a cross-departmental, sort of cross-organizational plan and vision for the process. And don't start on the transaction itself too early. Start on the readiness work early.
Yeah.
And that would be my advice.
Excellent. Thank you. And Matt, please bring us home.
Well, I don't know that I can add all that much. I would just echo what everyone said, which is if you're building a durable business, it will most likely be a public business at some point. And that means that your IPO is a moment in time that can do a whole bunch of good work for your business. And so use it to do that effectively. Use it to help you create the wonderful, durable business that you all are working so hard to create.
Excellent. Excellent. I'd be remiss to, put words in your mouth, Matt, and I would suggest everyone calls Class V, KPMG, and Wilson Sonsini when they start prepping for an IPO. Shameless plug. All right.
Thank you.
Of course. At this stage, we wanted to open up the floor to questions from the audience. And Colin, I don't know, are you going to moderate these questions or should I?
If you want to, you can, or I can come back on, but it's up to you.
I'll take the ones that I see. How about that?
Great.
All right. So if anyone has any questions, please feel free to put them in the chat, and I'm happy to bring it to the team. Okay. Well, okay. Here we got some coming through. What size company should be looking for an IPO? And maybe, Leslie, we can start with you in terms of the sizing that you're seeing of your clients currently.
I don't think there's a specific size. I really think what I would say is a couple things. Number one, in the current market environment, or in the market environment we've been in the last few years, investors do want a little bit more liquidity, which influences the size or the market cap of an IPO that goes public. But I do think that there's also an appetite for smaller IPOs. I think you need to be able to issue at least $100 million in equity to have the kind of float that attracts most of the types of investors that you're going to want to get into the stock. And so you really need to back into that. Like, what kind of company are you? What valuation if you're offering, let's say, 10% of your company, how do you do the reverse math on that to figure out what revenue or ARR level you need to sort of achieve the appropriate amount of liquidity in the market to have a successful IPO? So it depends. Does that make sense? But what I would say is a company should prepare to be public on a timeline that's right for the company's business, and should go public when they have the maximum visibility and confidence in the forward business. And yes, you need a minimum amount of liquidity in the public markets for the stock to trade and to get the right investors into it. But if it's the right time for the company, generally it's the right time to go public. So we think of it more that way. But I would say generally you need to be able to issue about $100 million in stock.
Excellent. All right, thank you. And then we also had a question come in about traditional IPO versus direct listing. And Matt, I'm curious, in the process of figuring out, which pathway you were going to take for the public markets, did you evaluate both of those options, or was it always an IPO? And if so, what really pushed you in that direction?
Yeah, we looked at all the different options, and there were others available, other acronyms that were available at the time. We obviously also didn't pursue, but I would say that it wasn't a very hard decision for us. Given who I am as a CFO, it was my first time taking a company public. I didn't have a long history of taking 10 companies public. But more importantly, given that we were a smaller name that was, not a, at the time, not a household name, certainly not in the investor community. We needed the exposure that comes from kind of the regular way IPO process. The analyst community needed to get up to speed on us, and so did the investors. And so that was going to be more straightforward through a normal way IPO than through a direct listing.
Got it. Thank you. And Gordon, we had a question come in about, can an Indian conglomerate list both on their domestic exchange or one of their exchanges, and then also America as well? Not going so much into the specific detail, because I believe that the answer is generally yes. Could you share maybe just some rules of the road of international companies that are looking to either dual list or be based internationally but list in the US from a regulatory and governance standpoint?
Yeah, I think there's certainly a number of complex issues that come up with this. And as you're a foreign company, thinking about whether or not, you will register as a foreign private issuer, there's a lot of analysis that goes into that. And so it really comes down to a lot of very company specific factors. It all certainly is doable, but it's something that you'll need to be getting ahead of early and talking to your advisors about to make sure you know which path to head down and how to navigate that path.
Excellent. Excellent. Thank you. And then, all right, so I might, Matt and Leslie, this next question seems to be all you both. It's, can you give us your advice on how to find underwriters for an IPO? Do you need to have a firm commitment for a lead underwriter before you start the S1? Will you be able to get a syndicate of underwriters after a draft of the S1? So I guess it comes down to when to engage in banks, sign them up, and what the process is relative to the S1. So maybe Matt, maybe starting with you, any thoughts on that?
Yeah, I mean, I think that there's a timeline that Leslie will help you put together, and it will be very clear about when you should engage those banks. And I don't really, I mean, tying it to the S1 is obvious, but I do think that the conversation with the banks comes in many different flavors, and it takes a lot of time as you're building that syndicate. It's not an organizing day or an RFP day. It's a long set of conversations. And I just want to make sure I emphasize that the bankers that will help you get organized and will help you write your S1 and those type of things are important, and you should definitely cultivate those relationships over time. But don't forget the analyst community. You kind of you date your relationship banker, but you marry your analyst. So make sure that you're spending time with your analysts well before you're in the S1 throws and the roadshow process.
Oh, that's such a good point. And Leslie, can you talk about the analyst engagement process? What are just some good rules of the road in order to really get to know them and develop relationships?
And just also in the underwriters, I'll say, some companies like Duolingo have every underwriter on the planet that wants to work with them. But there's some companies that it takes a little bit of work to get attention that maybe aren't in, mainstream areas, right? Their business isn't well understood. Those are different processes, so I don't know who's asking you the question, but you would run a different investment banker process depending on where the company fell in that. With respect to research analysts, we love research analysts and respect them. They are the ones that do all of the work long term, covering the company for years, and we appreciate them and we treat them that way, as important as they are. And so we do want to develop relationships with them prior to IPO, but we don't want to do it before we're buttoned up. They are not a group that you go in and tell your hopes and dreams to. They are they love to listen to them, but then they want they get judged based on how accurate their estimates are, how accurate their ratings are, how the quality of coverage, right? They don't want to be wrong. So you don't really want them to see you making the sausage. So I would say, yes, develop relationships with them, but just like investors, we want our companies to be pretty buttoned up when they start spending a lot of time with them.
Oh, you bet. You bet. And I'm going to stick with you, Leslie, because there's actually probably the best question that we've gotten all day. It feels planted, but I like it. At what point does a company start to engage with someone like Leslie? And what does that look like? And additional context is, as an entrepreneur, I think of my company as durable, but I'm too early to say that I want to go public in 2 years. Any thoughts on that?
Ask Matt that question. I mean, Matt and I dated for a long time. I mean, Duolingo and I, I'm just kidding, but they considered a lot of different advisors, and like everything that Duolingo did, they asked a lot of great questions. And I think, and I like that, because for Liz and I, and that's my partner at Class 5, great questions are what we love. And the more questions I got from Matt, the closer we got and the more comfortable he was working with us. But I think, Matt, I think we probably worked with you 2 years in advance. I'd have to go back and actually,
Yeah.
and I still work with Matt, from time to time on strategic IR issues. He has a wonderful IRO that does a great job, but sometimes I'll help them a little bit with that. But so 2 years in advance of IPO to 18 months at a minimum, I would say, is when you should start engaging with us. And honestly, there's some companies we've worked with for quite a bit longer than that, because sometimes the journey's not linear. They stop to make an acquisition. They stop to do something strategic along the way. Most of our companies keep working with us even during those periods because they still want to keep the readiness work going on. But Matt, I'll let you jump in and
No,
add
that's
your.
exactly right. Yeah. It was even before I joined as CFO. The company was talking to Leslie, and I would just echo it. I think 2 years makes sense to check in, and probably a little bit before that to see how your questions evolve and what you're thinking, and then 2 years is a great time.
Great.
And it might
Great,
be a
thanks.
rolling 2-year calendar. So just
Rolling.
depends on the.
And if you're doing a late stage private round, we like to be there to at least give you our point of view, because that can be very important in setting the stage for the IPO, just on investor selection and structure. Hopefully, no structure, but those types of things.
Excellent, excellent. And just to close us out, Marissa and Gordon, I'm going to go to you both and ask generally the same question. When is the best time, Marissa, to engage you and your team and start exploring that relationship?
I think this is one of the delicate answers, but it's one of those things where it's don't do it earlier than you need to. Obviously, a Big Four audit or any audit, but especially a Big Four audit, is a lift for the company and their accounting team outside of the day jobs the accounting team already has. So absolutely, we love to have those conversations similar to Leslie and be involved and helpful as early as is needed. But definitely, you want to get comfortable or grow that muscle in executing the audits. And so, a few years out prior to is a great time from the audit perspective. We are also obviously a tax and advisory firm as well. So those things can definitely be engaged with earlier as companies are looking at R&D tax credits, tax compliance, technical accounting, advisory services, etc. So But of course, I'm always happy to help. I love working in this space because I love helping. So I love to chat all the time.
Awesome. Thank you. And Gordon, over to you.
Yeah, slightly easier for me since we don't have the scariness of a PCAOB audit next to us. We will work with companies that are day one with founders, and we'll work with companies that we're taking over right before an IPO. And I've done both, and you can do both great. I think, when we're able to get in and really build that relationship over time and through private company rounds and helping them on that preparation, it makes the IPO process very smooth and very seamless. And so we're always happy to work with high growth companies, and there's a lot of great companies out there that we're thrilled to build relationships and have relationships with.
Excellent. Thank you. And I think we are officially 1 minute over schedule. So in a moment, I'm going to turn it back over to Colin. But I first wanted to thank all of my panelists for joining us today and sharing their insights and taking time out of their day. I hope that it has been valuable to everyone in the audience, and thank you for participating as well. Colin, over to you.
Thank you so much, Dan, Marissa, Leslie, Gordon, Matt. Dan, thanks for leading the charge and bringing these awesome real-world experts on this topic all together today. Really appreciate it, and we'll be in touch. Thanks, everyone. All right, we're rolling this boot camp train down the tracks. So before we transition into our last two sessions of the day, we're going to take a really quick break and then be joined with our entrepreneurial policy update post-election. So we will see you in 5 minutes. Hang tight, get a new cup of coffee, and we'll see you in a moment. All right, all right. Welcome back. So up next, we have our next special guest to present on post-election entrepreneurial policy updates. So welcome, John Deary, who's president at the Center for American Entrepreneurship. Welcome, John.
Here I am.
Amazing. Can see you.
Am I
And
there? There we go.
looking
Thank you,
forward to
Colin.
learning more. Thanks again.
I appreciate the invitation very much. It's great to be with you all to share our ideas and where we see opportunity with the new administration and the new Congress following the elections on November 5th. We're fortunate and very proud to be great friends and collaborators with the NEC, so I very much appreciate the opportunity. Before we get to our ideas, I'll tell you a quick bit about the Center for American Entrepreneurship. Anna, if you'll flip that slide. CAE is a nonpartisan. We will work with anyone on behalf of entrepreneurs. Nonpartisan research, policy, and advocacy organization that was launched in July of 2017. Our mission is to work with policymakers here in Washington, both in Congress and in the administration, to improve policy circumstances for you all. We are, in short, your team in Washington, and we very much hope that you will think of us that way and stay in touch with us. And I'll start by saying, if there are ideas or issues that people have that you think that we should be engaged on in Washington and speaking to policymakers about, I would encourage you to get in touch with me. My email is John, JOHN, at startupsusa.org. Feel free to get in touch anytime. Real quick, why do we do what we do? Anna, if you'll flip the slide again, the answer is, in short, you all and the businesses that you're building are really important to the economy in a couple of key ways. First of all, there's lots of research that's been done over the last 10 to 15 years that shows that startups and entrepreneurs, the phrase that's used in the research, are disproportionately responsible for innovation in the economy. If you stop to think about it, that makes sense. The reason why you guys start a business, you've got something new, a new product, a new service, a new twist on an old idea. And it's that newness that is really key. The economics behind that is we know from the great work of an American economist named Robert Solow, who won the Nobel Prize in 1987 for this insight and really changed the way the world thinks about economic growth, is that economic growth is driven principally by gains in productivity driven by innovation. And as the principal source of innovation in the economy, especially big innovations, startups are really important. Existing companies, of course, innovate as well, but it tends to be at the margin. They're not particularly well positioned, and frankly are not particularly interested in what you might call, major or transformational or disruptive innovation, because they're the establishment. They're not interested in being disrupted. It's almost always an entrepreneur and a startup that contributes that kind of innovation. And in fact, if you look back over the last 200 to 250 years of the economic landscape in this country, the vast majority of major innovations that have really defined the economic landscape, and I've got a number of them up on the screen, all came from entrepreneurs. So from the standpoint of innovation, which drives economic growth, you all in the companies that you're building are incredibly important. And if you'll flip the slide, the second aspect of your contribution to the economy that's really important and is sort of a corollary, when you think about it, to the importance of innovation and economic growth, is that new businesses are responsible for virtually all net new job creation. And this is a conclusion that has been reached or demonstrated by a number of different sources, by researchers at the Kauffman Foundation in Kansas City, folks at the U.S. Census Bureau, John Haltewanger at the University of Maryland, showing how important new businesses are to net new job creation. And I say the word net. Again, existing firms do create jobs, of course, but they also shed jobs as they focus on what they're best at, as they incorporate capital and technology. And in fact, Tim Kaine at the Kauffman Foundation showed that if you divide all businesses in the economy into two basic categories, older than 5 years old and younger than 5 years old. He showed that businesses older than 5 years old shed about 1 million jobs a year on a net basis, which is another way of saying essentially that were it not for young businesses, startups, the job space in this country would shrink by about 1 million jobs a year. So from the standpoint of innovation, economic growth, and job creation, you all are where the action is at. And are deserving, therefore, of advocates in Washington, D.C., interacting with, engaging with, educating, and working with policymakers on your behalf. And if you want to see more about our agenda and all the various issues that we're focused on, feel free to browse our website, which is startupsusa.org. But now I'll flip to Anna, if you'll go to the third slide. I'll focus in on some of the issue areas that we're specifically focused on following the elections, and I'll run through these quickly, and then we'll see if there are any questions on the other side. And the first two here are really topics that we're concerned about or a little worried about, and then the rest of them are areas where we see some significant opportunity to move the needle on your behalf. And the first is the continued funding of the CHIPS and Science Act. The CHIPS and Science Act, as many of you will recall, was signed by President Biden in August of 2022. In our judgment, it is the most significant innovation-related piece of legislation to come down the pike in decades. And has three basic parts to it. One is billions of dollars in grants and subsidies aimed at encouraging and facilitating the onshoring of chip manufacturing here in the United States, and a number of chip companies, Taiwan Semiconductor, Intel, Micron, Samsung, et cetera, are involved in that. Secondly, billions of dollars in strategic investments in critical technologies and scientific fields. And then thirdly, the creation and funding of a tech hub network all around the country that will really amount to a national infrastructure focused, each tech hub focused on a specific area of technology that is really our national network or infrastructure for innovation and entrepreneurship. An aspect of CHIPS and Science that we think is incredibly important in the future of American innovation and entrepreneurship. The CHIPS Act authorized $10 billion for the funding of the Tech Hub network, but only about $500 million, so 1/20th of the $10 billion that was authorized by Congress has actually been appropriated. Here in Washington, there's always a difference between authorization and appropriation. Authorization is sort of permission by way of the legislation, and then the funding has to be appropriated thereafter. $500 million is a lot of money, and the administration, the Biden administration, announced the $500 million commitment to 12 tech hubs in July of 2024 of this year. But they had previously identified a total of 31 tech hubs in October of 2023, funded 12 of those in July of this past year with $500 million. But that's only 1/20th of the 10 billion that has been authorized, and we're worried a little, frankly, that some of the signaling from the incoming administration, the focus on reducing the size of government, the focus on reducing the size of government debt, all very important to be sure, but we think because there are real savings to be realized by not continuing the funding of CHIPS and Science, we're worried that CHIPS and Science could be a victim of those efforts. We hope not. We hope that the administration will see CHIPS and Science for what it is, and that is our national game plan for meeting the competitive and strategic threat from China. And we very much hope that funding, especially the tech hubs, will continue. Second of all, tax reform. A major signature achievement of the first Trump administration was the Tax Cuts and Jobs Act, the TCJA, in 2017. Major aspects of that tax law will sunset at the end of 2025. And so reauthorizing the Tax Cuts and Jobs Act is going to be a major priority early in the administration and in the new Congress. One aspect of the Tax Cuts and Jobs Act is really significant for startups and problematic for startups, and that is to help offset some of the cost of reducing corporate tax rates in 2017. Congress changed the tax treatment of research and development investments. For 70 years prior to 2017, American businesses, including startups, were able to write off or expense their investments in research and development in the first year or the year that those investments were incurred. And this was very, very important policy because it encouraged R&D investment and was especially significant for startups because startups do a tremendous amount, a disproportionate amount of research and development as they're testing, perfecting, prototyping their new product, their new service, and being able to write off or expense those investments in the first year was really critical, both to their ability financially to do that and to their financial well-being. The Tax Cuts and Jobs Act changed that, and businesses starting in 2022 were required to amortize those investments over between 5 and 15 years, depending on where the R&D was done. If it was done outside the United States, it would take 15 years to amortize those investments. But even the 5-year amortization of R&D investments is really problematic for startups. And so it's our hope that in the reauthorization of the Tax Cuts and Jobs Act, that will be fixed and Congress will restore first-year expensing of R&D investments. Encouragingly, there was a tax bill, bipartisan, bicameral, very, very strongly supported in both chambers of Congress on both sides of the aisle. It was called the Tax Relief for American Families and Workers Act that passed the House. It was negotiated between Republicans and Democrats, Senate and House, late last year and was passed in January of this year, passed the House by a very wide margin, 357 to 70, which is almost unheard of in the House. Strong bipartisan support. It went to the Senate and then was stopped in the Senate. It got caught up in presidential politics. But because it had broad bipartisan and bicameral support, we're very hopeful that aspects of that bill, including the restoration of first-year expensing of R&D investments, will be included in the reauthorization of the Tax Cuts and Jobs Act. High-skilled immigration reform. Now, this is one where you might be puzzled as to why we think there's opportunity here, but I really think that there is. We all know the feelings and the positions of President Trump and many Republicans in Congress with regard to immigration and their focus on the southern border and his promise of, for example, deportations of folks, and that. If you focus on that, it can be very concerning in terms of the broader objectives of further immigration reform, and particularly high-skilled immigration reform. But when the topic of high-skilled immigration reform has come up in recent years, Republicans' response has typically been secure the border first, which is not an unreasonable position, especially over the past year or two, given the crisis at the border. A number of you are probably aware that earlier this year, in the midst of that debate, Senator James Langford of Oklahoma, a conservative Republican senator, negotiated with the Biden administration what by all accounts is a very robust and conservative border security bill that would go a long way to securing the border and putting very, very tough restrictions and requirements for admittance. That bill also passed the House with strong bipartisan support and was also stopped in the Senate due to presidential politics. If you assume, and I think it's a reasonable assumption, given the broad bipartisan support and the emphasis that President-elect Trump has put on securing the border, it's our expectation that that bill will come up quite early in 2025 and will pass with broad bipartisan support. If that happens, then the Republican response, secure the border first, that box in effect gets checked. That doesn't necessarily mean that they will move on to high-skilled immigration, but having secured the border, and particularly in the context of even Republican concern about the competitive threat from China, which involves access to talent, to high-skilled talent. It's our hope and it's our view, frankly, that there is going to be a real opportunity for high-skilled immigration reform following the passage of that border security bill. And in fact, President Trump in recent months has mentioned support for certain aspects of high-skilled immigration reform, including one that is an aspect of what CAE has been in favor of and working toward for some years, and that is what the concept of graduation green cards. As many of you know, the United States has the largest foreign-born student population in the world. Our higher education system is an enormous strategic advantage because we attract about 1 million foreign-born students every year. Those graduates account for a disproportionate share of the STEM graduates that our college and university system produces. And the basic idea of graduation green cards is, provided those folks pass a national background examination, in other words, provided they're not spying on the United States, and if they want to stay, why send them home? Why deport them? Which is essentially what our immigration policy right now does. Let them stay and give them a graduation green card. The other aspect, specific policy in this regard that has been a priority of CAE's for years, is the establishment of a startup visa. Believe it or not, the United States is the only industrial democracy in the world that does not have a specific visa category aimed at recruiting or attracting and retaining foreign-born entrepreneurs who want to start their business here in the United States. Our economic and trading competitors, almost all of them, including China, Japan, a number of countries in Europe, Canada, Mexico, New Zealand, Australia, have overhauled their immigration policies over the last 5 or 6 years to include or to create the equivalent of a startup visa. So our two specific high-skilled immigration priorities that we think are possible in 2025, assuming the border bill gets passed, is the creation of graduation green cards and a startup visa. The other issue area that we think is going to be more favorable following the election and the Republican majority in both the House and the Senate and at the other end of Pennsylvania Avenue is the topic of capital formation. And in particular, Senator Tim Scott in September, who is a member of the Senate Banking Committee, and following the Republican majority victory in the Senate, he will be the chair of the Senate Banking Committee, which is the relevant committee, the Committee of Jurisdiction for Capital Formation, which together with the House Financial Services Committee, which also will be chaired by a new Republican following the departure of Patrick McHenry. Senator Scott introduced in September a very ambitious capital formation package that he has called the Empowering Main Street in America Act. It's comprised of about 8 or 9 individual bills, including a bill that came out of the Center for American Entrepreneurship called the Expanding American Entrepreneurship Act. The purpose of that bill is to amend the Investment Company Act of 1940 in ways to get more capital, in particular to women founders and entrepreneurs of color. There are aspects of Section 3C1 of the Investment Company Act of 1940 that has the effect of keeping the investor base, investors who invest in funds that invest in startups, overwhelmingly white and male. There's nothing wrong with being white and male. I'm white and male. I'm a pretty good guy. But there's lots of research to show that who gets funded depends on who is doing the investing. And therefore, if you want to get more capital to more women founders and entrepreneurs of color, you want a more diversified investor base. And that's the purpose of that bill. So we're very bullish on capital formation in general and on the Expanding American Entrepreneurship Act in particular. Finally, obviously, the incoming administration and Congress is much more focused on reducing regulatory burden and complexity. Very, very important for all businesses, especially startups. Startups are uniquely vulnerable to regulatory burden and complexity. It takes founders' eye off the ball of what they should be focused on, and you're already seeing the impact of this renewed focus on regulatory simplification and burden reduction reflected in small business confidence figures. The NFIB Small Business Confidence Index, I believe it was last week, hit a 3.5-year high, as confidence among small business owners has really jumped since the election. I think a lot of that has to do with the incoming crowd's focus and orientation posture with regard to regulatory simplification. A couple of other issues that we're watching that are relevant for entrepreneurs, obviously, but we don't really know where the new administration and new Congress, what their standing is going to be. But I wanted you to know that we're watching, and that is antitrust is one of them. As you know, the Biden FTC and antitrust division of the Justice Department has been very aggressive in blocking and putting in policies designed to block or to obstruct the acquisition by larger companies, including large tech companies, of smaller companies, including startups. A number of those initiatives were real threats to startups because, as you all know, acquisition is by far the most frequent and important avenue of exit for startups and their investors. And so it'll be very interesting to see what the policy posture is of the new administration and Congress with regard to antitrust. Workers' rights. And here I'm talking about the treatment, the policy treatment or regulatory treatment of gig economy workers and independent contractors on whom many startups rely for their talent needs. Another topic in that category is the approach to non-compete agreements. One very positive thing that the Biden FTC tried to do was to ban non-compete agreements. We are very much in favor of that. Believe that the banning of non-compete agreements is very pro entrepreneurship because it's very pro labor mobility. So it'll be interesting to see what this administration's view is with regard to that. And then, of course, trade. A worrisome aspect of President Trump's policy agenda. He seems convinced that tariffs are a very powerful and important part of our trade negotiations with our trading partners. Depending on how that policy is pursued, it could be very problematic for the U.S. economy in general, and therefore problematic for small businesses and startups. And so we're watching that carefully as well. I'll stop there. I think that's a lot of issues, a lot of issue fronts that we're going to be active on over the course of the coming year. Happy to answer any questions that anybody might have about any of those issues or any other ones.
Awesome, John. Well, first of all, thank you so much for that overview and for the work that you do at the Center for American Entrepreneurship. We are a little bit behind on schedule, so if you have any questions, please feel free to reach out to John on LinkedIn. But John, thank you so much for joining us today, and we're on to our next.
Thanks for the invitation.
Amazing. All righty. Well, our final panel of the day is Achieving Success as a New Public Company. So without any further delay, please join me in giving a warm welcome to our next panel of experts. We have Adam Sterling, who's an Assistant Dean of UC Berkeley School of Law, who's our moderator and close friend of the center. We have Andy Gilman, who's a partner at Wilson Sonsini. We have Byron Laughlin, who's a global head of Nasdaq Board Advisory and Nasdaq Board for Center for Board Excellence. And we have Naveen Ricky, Managing Director at KPMG. Team, life as a public company, looking forward to this conversation. Adam, I'll let you guys round us out. Over to you.
Great. Thanks, Colin. Well, great to be back at the center, even if it's virtual. I think I was one of the first instructors when the center opened in 2015. So I love supporting the work that you all do. As mentioned, I am Adam Sterling. I am an assistant dean at UC Berkeley at the School of Law, where I teach and focus on venture capital, amongst other things. We have an incredible panel here today. And I think what we'll do is we'll ask each panelist to introduce themselves and talk a bit about their work and what they focus on, how they work with public companies. So Andrew, we'll start with you.
Thanks, Adam. Hi, everyone. My name's Andy Gelman. I am a corporate and securities partner at Wilson Sonsini, based out of our Palo Alto office. I represent companies across their life cycle, from early stage all the way through mature public companies. Look forward to catching up with you all today on one of the favorite parts of my practice, which is really that important transition right after a company goes public.
Great. Thanks, Andy. Byron.
Thank you. Hi, glad to be here. Byron Laughlin, and I focus in the boardroom around advisory from small private through large public. Happy to offer insights on how to get your company ready or how to build a good board, that kind of area. Happy to be here. Thank you.
Thanks, Byron. And Naveen.
Hey, thanks, Adam. My name is Naveen Ricky. I'm a managing director at KPMG's Accounting Advisory Services practice. I'm based in New York, where I assist our clients in navigating the challenging terrain of capital market transactions and helping them IPO here in the US and also cross-border transactions as well. The work I do focuses on the pre-IPO preparation process, steering the IPO itself, and managing post-IPO transitions and helping management once they are now a public entity. I provide support not just in the financial accounting and reporting and regulatory aspect, but also on SOX compliance, IT and systems, taxation, and ESG. The areas that are necessary for a company to be an independent, publicly listed entity. I'm excited to share my insights with you all today. Thanks for having me.
Great. Well, we're just missing a banker, but we can all speak for them. Byron, let's start with you. Can you give us maybe an example or two of a successful IPO and maybe take it a step further and talk about companies that have successfully kind of sustained growth as public companies?
Sure. And let me preface it by you want to think in terms of the day you fill out your first form is the day you initiate governance.
Yeah.
So that starts the process. And so you want to set your processes up to meet the need of your governance and the growth of your company in a systematic way. Where I see companies get in trouble is where they let their company grow much more quickly than their governance, and then they run into challenges that can frankly be a lot more costly. So in terms of companies IPOing, what I see when a company IPOs successfully, then they have their, and when I say successfully, I mean both in terms of what hits the street on the first day and the way the street looks at it. You're going to find that when a company has their ducks in a row, let's call it, around their governance, instead of looking immature, the investors are going to look and go, oh, these people have, number one, good people around them and advising them, because you're not going to be able to set up all the governance. You're going to need people like Naveen and Andrew to assist in that. And then they're going to say, well, we can trust a little more. Of course, they're not going to trust you that much unless they know you well, but particularly on the retail investment side, you want people that can see what you've developed. That means today, it means setting up on your website so it shows what your governance looks like. Your committees, your structures, and a lot of this is not a heavy lift if you do it systematically from day one. And then as a public company, having the right advisors as well as that structure moving forward will give you greater confidence internally, and therefore there's a trust that your accountability structures are well developed so that there's trust externally. And I'll let others contribute now.
Great. Well, thank you for that. Andrew, my question for you is sort of common challenges that companies faced in the aftermath of an IPO, but I know Wilson Sonsini represents emerging growth companies throughout their life cycle. And I know you don't simply, wake up one day, decide to file an S1 and go public. I'm going to allow you to expand on that and sort of challenges that companies face pre-IPO, post-IPO. I'll give it to you.
Yeah, so I mean, I think I'll start with sort of one of the probably more obvious ones, which is the earnings cycle, right? So as a private company, you think about what your reporting requirements are, and you report to the board and you set out your projections. And I will say that, a lot of the times there's a lot of bumps in the road in terms of that reporting process. Companies don't meet their projections as a private company, and the ramifications for that may be a disgruntled board, you may get a little nudge. If things to an extreme, obviously, people could lose their jobs, but the reality is there's ups and downs along the way when you're a private company. As soon as you go public, you're suddenly in this heavily regulated reporting regime, and you're suddenly subject to these earnings cycles where if you don't meet those earnings targets, there's real and immediate ramifications to that, primarily the stock price. And so, you think about a private company, your valuation is maybe determined on an annual basis every 2 years as you do a new financing round. And there could be situations, maybe not so much over the last couple of years, but there have been situations where there's companies that have never had a down round before. And so generally morale is good, up and to the right, and that's sort of the general vibes up until you go public. But as soon as you become a public company, it is inevitable that at some point you won't hit that earnings target, and the price will take a hit. And I think one of the challenges that I see sometimes companies have is besides the obvious, the stress from the price hit, is how the employees react to that. It's sort of a morale hit, and having to kind of rally the team and understand, okay, this is a one-time deal. How are we going to get to the next milestone, which is the next quarter, is definitely a challenge. And I think also just the general headspace around the amount of time that is devoted to this earnings cycle, the periodic reports that you have to prepare, and you constantly having to go through that process is a big step change from being a private company, even if you've prepared for that change.
Yeah, big time. Thanks, Andy. We'll certainly follow up on some of that. Naveen, sort of piggybacking on Andy's points, talk to us about managing investor expectations as a public company. And as Andy mentioned, right, you're sort of, most companies have had significant investment as private companies, but arguably managing private investor venture capital expectations is different from public markets. So what does it look like as a public company managing those expectations, maintaining transparency?
Yeah. I'll echo, something that Andrew just mentioned, and that is, earnings guidance. So, expectations, as well as the cycle of preparing and producing regulatory reports. If I were to, in my experience, two issues that have definitely significantly negatively impacted companies right out of the gate after being a public entity, after becoming a public entity, is number one, missing and not being able to file their regulatory statement, financial statements. So a 10K or a 10Q or even an 8K. You can't do that right out of the gate, you're finished. Investors are taking a bet on you, and if you're not able to meet this very basic threshold, being able to comply with regulatory filing requirements and also meeting investor expectations, that does not bode well at all. And I have seen that happen. The other one is forward guidance. So being overly optimistic on what the company is going to do, because management does want to be able to paint a rosy picture, because that's the investment thesis they're communicating to investors, but not making your not meeting or achieving your earnings guidance right out of the gate is another item that will definitely negatively impact you. So I guess a few strategies that I've seen companies that I would advise, and I've also seen companies do to sort of mitigate and put their arms around this, to make sure that they are addressing this, is having a clear and consistent communication plan. Yeah, so this means making sure that they have the infrastructure and the ability to regularly release earnings reports in line with regulatory requirements. And these include financial statements, an MD&A that is well written, that provide the narrative on management stewardship of the company, as well as key performance metrics and forward-looking guidance. Having a good investor relations section of the corporate website, which is accessible to investors, which has got reports, presentations, and updates, and also prior earning calls. And that leads to my next point is hosting calls. So having frequent quarterly earning calls, explaining the results, answering questions, addressing marketing concerns directly and early. These are the kind of sort of behaviors and conduct where engagement with the investment community becomes a lot more fluid. And where they get credibility, when the company is able to gain credibility with the investor community. Setting realistic expectations, providing forward-looking statements that are rooted in reality and not being overly optimistic, providing optimistic projections, because that is something that will come back to haunt the company if they are, not able to meet it, and will prevent investor disappointment. And I think also highlighting risks, being very transparent about potential challenges and risk that the business environment, whether operational or regulatory or it's market driven, being able to identify it and communicate it and the impact it has on the business. I think this is something that investors don't like, is unpleasant surprises. So being able to identify these early and being able to communicate them is key. I think some other things I can also talk about are, building relationship with analysts and investors, engaging, your shareholders and stakeholders by conducting roadshows, having investor days to engage with institutional and retail investors. This certainly helps and builds a dialogue with your investor community. And having a media strategy. I think at this day and age, media and how you communicate and the method and the manner in which you communicate is also pretty important. So I think building a strong relationship with financial media and analysts, and also the method and how you communicate on social media, this also certainly helps. And I think the last one I would say is how well does management, manage bad news? How do they plan for crisis? So having a plan to handle adverse events, whether it's an earning miss or some other controversy, and being transparent and being timely with communication and not being delayed and being reactive is really important. And I think finally, just focus on long-term vision. Remind the stakeholders of the company's long-term goals, and to counteract any short-term setback that they may have.
Adam, you're on mute, but I can follow up on that a little bit. I'd be happy to follow up because those were excellent points, Naveen, and I can connect it to the board a little bit. Is that when you're thinking about building a high performing board, they're there to help you with the things that Naveen was talking about. So areas like investor relations. Not that you want your board to be representing you and investors, no, advising you, because you bring in these 8 or 10 people to provide a sounding board for the areas where you may not be in it day to day. And so building a good media strategy should be high on your list. And a high performing board, they help you with areas like volatility, uncertainty, and the areas of complexity. And what I would emphasize is you want to build that board so that, and as you build it, there are people that understand how to help you to evaluate things. We call it the smell test, or noses in and hands out. They should be there to say, hey, does this feel right? Does this smell right? These kinds of people that have experience, but they're not going to get their fingers in there and tell you how to run your business, because that could stall innovation. And my last comment towards this is, as Naveen was talking, is emphasizing something that I like to work with boards on, is building the confidence in the relationship between the board and management will simultaneously build confidence with investors. And that confidence allows for higher levels of accountability, because you have the confidence in a relationship that the accountability can be open, transparent, and robust.
And can you, open to anyone, sort of help our audience think about a timeline? So imagine a company IPOs Q1 of 2025. When do they start expanding or thinking about what their board will look like with independent directors? When are they sort of professionalizing investor relations teams, like things that I think a lot of venture-backed private companies don't spend much time thinking of?
Well, my first, and then I'll let others answer, is they should have been thinking about that in October or September of 2024.
Yeah, if not earlier.
Yeah, I agree. I mean, I think the board in particular is a long lead time item to find the right members to make up your board. It's not something that you can kind of flip the switch on right before you go public. Especially if you want to kind of have your board in place and sort of develop rapport before you get thrown into the mix of a newly public company. And I think I think you have a little bit more lead time. You can get a little bit closer in time in terms of IR function. But again, these are all muscles that you want to build earlier in advance, and it will lead to a more successful IPO public company experience.
And what are the, given, I think we've touched on a lot of the drawbacks, reporting requirements, board expansion, a lot of time and money. What's the upside to going public, especially in a world where arguably companies can raise more and more money in private markets?
That's true. I mean, there's private markets for sure. There's still greater access to financial markets in the public sector. There's opportunities that you may have by being a public company that you wouldn't otherwise in terms of raising capital. I think also you see a lot of companies using their public company stock as a currency for acquisition. So if you're a company that wants to get into the market and doesn't want to have to use cash on hand, that's another way that you can use your equity. I think something that's particularly important right now is probably employee and investor liquidity. We were sort of on a great run in terms of IPOs up until, let's say 2021, early 2022, and it sort of fell off a cliff. And so you have a lot of these private companies now that have really been sitting around for a while, waiting to tap into the public markets. And with that, you have a lot of employees who have equity that might be expiring at this point, and looking for ways to get liquidity sooner rather than later. So I think that's becoming particularly relevant now as you have these sort of late stage private companies that thought they were going to go a few years ago and now are 3 years later and sort of are getting to the end. VC funds as well. I mean, there's VC funds that are sort of end of lifing and need to get their liquidity. So there's on the investor side, which I kind of loop employees there. There's sort of the drive as well in terms of the benefit of going public. And I think there's always this credibility and brand recognition. I mean, I think the IPO is still this sort of monumental event for a company, brings branding to the company when it happens. And I think for companies that are contract with large enterprises in particular, I think it can give them a little level of credibility and help them get the foot in the door for those type of relationships. And I will just add one drawback that I don't think we have covered here yet is certainly the legal exposure that goes with being a public company. Besides the regulatory and the cycle and all that, you sort of, we talked about this earnings cycle and missing your projections. Besides the stock price dropping, you immediately have a target on your back when those things happen. And so I will say that additional downside is the additional potential litigation risk, which is obviously not good for anyone. So
just to add,
anyone else want to weigh in on pros and cons?
Can I just add to what Andrew just mentioned? And I think this is really important, especially in the technology sector, which is very competitive for human resources and finding talent. I worked on client engagements on more than one occasion where one of the primary drivers of the company doing an IPO was to be able to get currency that they could use to attract talent. And, the CEO who I spoke to said, if we are not able to complete this in the next year and ensure that we have a pipeline of talent and being able to match our growth projections of how we, plan for this business to evolve, then we will not be able to do so. So it was critical, it was important, and it was tangible. And luckily, they were in a good position where they had decent valuation. But this ended up becoming particularly important with those companies that are cash starved and can't pay cash salaries. Then equity is the way to go, and especially in some sectors like technology, it really does become a problem. Where they need to hire talent, which is scarce.
And to follow on Andrew's comment, because both are good comments, but to encourage the capital markets, the Nasdaq side of things, is that I do believe that there is a very important place for the democratization of capitalization, and so that anyone can invest in a company. Where PE has a wonderful place in our society, but it also means that you're answering to that PE company. And there's limits there. There's other limits there. There's capital limits in terms of the capital that the PE can fund, where if you've got the most exciting new mousetrap, the upside could be put unlimited in the public markets.
And Andy, just to level set here, can you help us understand an IPO sort of money that is being liquidity for existing investors, employees versus new money being raised for the company?
Yeah, absolutely. So, I mean, I think there's sort of an IPO can be entirely a primary raise, where it's just the company raising new capital for the company to be able to fund its operations. It can be primary and secondary, which is secondary is when, you know, certain employees are permitted to sell as part of the offering. It could be a combination of the two. It could be all secondary. I will say that post IPO, even if it's a full primary offering, you know, following an IPO, the company will be publicly traded, and it may be some period of time due to a lockup agreement with the underwriters. But at some point, the employees will be able to sell some of their equity as part of the financing. We'll also add that there are variations of structures now. Direct listing is something that was sort of in vogue a few years ago. We'll see if that sort of creeps back. I will also add that in terms of employee liquidity, even though historically there's been this sort of concept of 180-day lockup, there's been wide variations of that structure. Sort of in the height of the 2020, 2021 boom, we even saw things where there was sort of a day one lockup release where employees were able to sell day one in connection with the IPO. I don't know if we'll see that again, kind of coming, you know, in the new world of IPOs now, but that is something that we've seen historically as well.
Yeah.
Agreed.
Naveen, thanks, Andy. Can you share a bit about sort of best practices for building out that IR, investor relations function, you know, communicating with shareholders?
Yeah, sure. You know, it's a three. I would say it's a few prongs, the few spokes to this wheel. I mean, investor relations takes place throughout. It's not a one-time event, but it takes on. You know, it is a process that takes on throughout the period that the company is operating, so throughout the year. And in small doses, like, you know, your Twitter, the company's official Twitter tweets or social media releases and so on and so forth. You know, as I have seen private entities get ready to become public, you know, this is not an area that has been a particular focus simply because they are owned by VC or PE firms, and they have a private reporting that they just need to make sure that the board gets the information need that they want. But I think going public, you know, working with investment relations consultants and firms who specialize in the companies of this particular sector, and seeing that they have a track record who can come and help you to articulate, you know, what the company's investor communication strategy should be, as well as curate messaging in a manner that resonates well with the investor community. And this will take you know, form of number one, the very basic is everything boils down to, you know, your regular financial reporting. So what is in your quarterly and annual SEC filings, so your 10Ks and your 10Qs, because a lot of the information that you'll be able to communicate to investors is going to be already residing in there. And it's a matter of taking out elements from there that the investors expect. Comparing to other companies, you know, what are your peers doing? How are they communicating, and what are the themes that they're using that investors like and have now set the bar for the industry and perhaps for companies in general? So it's doing a study of that, which include things like, for example, you know, looking at their earnings calls or listening to their recorded earnings call. What kind of questions do they get? How do they answer them? Are they very transparent, or are they very economic with the amount of information that they disclose? As a new company, you know, IPO company, you're probably not going to be able to be too economic, but also there's not that much benefit to being very transparent in terms of disclosing every single thing, simply because if you tell investor analysts something now, guess what? The next time round that you have an investor call, they're going to ask you that question again. So I think having an investor relations consultant who can help hold your hand or company's hand and help them to understand and articulate what the strategy should be and building up that infrastructure is key. And I think just being transparent, being timely with your disclosures and with your corporate announcements, all of this buys credibility in substantiating and supporting the company's strategy and management stewardship of the business.
Yeah, thanks, Naveen. Byron, question for you. So in the sort of private company context, valuation and share price are somewhat static, right? Like when I'm seeking a new round of financing, I'm negotiating that with my investors. As a public company, it's dynamic, right? You have a stock price. And how do kind of, you know, founders, executives advice for managing that?
Advice for managing
shareholder expectations, maintaining stock performance, post IPO.
Post IPO.
Yeah.
Well, you want to report well, and this is where I feel like I have a strong opinion on the governance of this.
Please.
One, you want to report well. Two, you want to have systems in which people are gaining confidence on an ongoing basis. If they investigate anything about you as an investor, that you're providing a level of transparency that they gain confidence in your organization. And to the IR side of it, you want to know your investors. If you can afford it, you want to put some money into stock surveillance or investor relations so that you know your customer in the investor sense and know them well, so you can anticipate also who should be in our stock, who's not in our stock and should be in it. How do we identify that? Because that's one of the benefits of going public is anyone can invest in your stock, and the anyones include a lot of funds. And even at a smaller level, there's more VC kind of funds out there. And the one rule I would emphasize both in the boardroom and in communicating to your investors: surprise is the enemy. You can carry that strongly through. If you can, an upside surprise can be okay or quite good. But you want to even then define why the upside surprise, because a very savvy investor is going to go, wait a second, is this just sandbagging? Probably all of us have invested in something where there's been sandbagging. It flies up and then all of a sudden it drops like a rock. And so communicating to your investor effectively is one of the most important parts. And again, that's where a strong board will help you build that muscle.
Can I just add to what Byron just mentioned on his first point regarding having the investors that you want? I have seen some clients try and chase particular anchor investors, and when we were asking them what's the purpose of this, they said, look, they're very influential in the industry, and if they come and invest in us, then others will follow them as well. For example, I'm just making it up. If Warren Buffett was to come and invest in your company, everyone's going to look at you and say, oh, Warren Buffett is investing in you, so maybe you're doing something right. We'll also come and invest with you as well. That kind of approach and strategy really does work well. And the challenge is to have the contacts and connections and perhaps board members who are able to facilitate that, to present the company as a investment thesis that they're looking for. This will help not just the valuation, but support the share price and make sure that any volatility is within a reasonable band and it's not something that is jumping up and down.
Great. Andy, any kind of thoughts on sort of this challenge of balancing, short-term financial results with long-term strategic growth as a public company?
So I'm going to sort of address this one a little bit more from a disclosure angle here. Yeah. And I think part of it starts with setting the expectations up front at the time of the IPO. I think, being very transparent with your investors at that time as you go through your TTW meetings and sort of laying out what your expectations are. And as folks have mentioned on this call, not being overly optimistic. I think also choosing the right key metrics that you want to use throughout your offering documents. I think one of the common things that we see sometimes with companies is they switch key metrics within their first year. And part of the reason for that is how sometimes those key metrics come to be is, you're sort of sitting around a big conference room table with the bankers and the company. And instead of sort of focusing on how do we look at the business, both in the near term and the long term, it becomes what makes us look the best. And maybe that works for a short period of time, but as you kind of get past that IPO phase, that can become problematic and doesn't necessarily reflect how the company views the business and how they want to direct investors to look at the business, both in the near term and the long term. And the only other thing I'll add, and this is probably a little bit more on the tactical/governance side, but if you're able to do it, one of the primary benefits of putting in place a dual class capital structure is the ability to focus on the long term and not have to necessarily focus on those sort of short-term bumps in the road and noise that you see in the short term. And so, we've seen over the years, particularly in the technology sector, a lot of companies, when they're able to, particularly those founder-led companies, moving to a dual class structure, and that's sort of one of the benefits of that as well.
And when you say able to sort of have the leverage to do that and still be successful and, you know.
Right. Right. And you sort of see that with sort of the founders that, have led the company since the beginning, and sort of, these big personalities that investors are investing in them, and they see them as sort of the driver of the business.
Yeah.
And there's some real advantages to that as the company goes public.
Thanks, Andy. Naveen, for you, can you speak to sort of opportunities post-IPO around sort of access to additional capital? How does it change the potential for acquisition being a public company?
Yeah, that's a good question, because that's a real significant advantage that public companies have that is not available easily to a private entity, right? So a company that has done an IPO already now has the access to permanent capital. So they've got the fund that they raised in an IPO, and perhaps later on, they have plans for further investment or an opportunity to increase value by investing in assets or some particular technology, whatever it may be. They can always go back to the market for a secondary offering, and that window remains open permanently, depending on facts and circumstances, how much you already have out there, what your authorized capital is, and so on. But this option is always available to you, and companies have this access for secondary offerings to raise further funds. And then finally, there's also debt financing. Now that the company is really well established, it's got clear communication and credibility with the investor community. They probably understand and know the risks. Companies are perhaps able to secure more favorable terms for debt than they would have been able to had the company been a private entity. So these are things that become particularly advantageous to a public entity as far as securing additional financing, whether it's further equity or debt financing, and ultimately, reduce their weighted average cost of capital. And I think as far as currency for acquisitions, I think there's really nothing like it. The leverage that equity offers you or offers the company to make acquisitions for other acquisitions is amazing. You don't have to go to bankers. You don't have to go to anyone else to raise that capital. You can do it on your own because you already have it. It's a significant advantage that private companies struggle with. And I think one of the beauties of this particular issue is that you already have discovery of your valuation because you have a publicly quoted stock price. So as the stock price continues to increase, it makes opportunities more affordable. And you can beat the competition in securing an acquisition or target that you're looking at. So I think in the post-IPO period, I think opportunities for expanding your capital base and getting more permanent capital and acquisitions, I think is significant, and also attracting top talent, as I mentioned earlier on.
Yeah. So question for the group, and then we're about to transition to Q&A. And I see there's already some great questions from our audience, but any sort of lessons learned from companies that you've worked with around challenges or failures in their IPO journey, and how can future IPO candidates avoid similar pitfalls?
I'll go first. I'll mention a couple of things. Number one, prepare early. Okay, so it's never too early to start thinking about and preparing for the IPO journey and preparing for it in terms of what needs to be done, understanding and ring fencing all the areas that would need to be addressed in a given time frame in preparation for an IPO. Okay, there's no such thing as over preparation. So I normally counsel my clients to think, at least 1 year in advance. Sometimes it usually happens much less than that. But 1 year in advance or even more, thinking about it and making sure that they have the right people in place, they have the right processes they've been able to align, and do they have the right technology to sustain the company, not just do an IPO, but also to sustain the company as a public entity. The second thing would be, which is somewhat surprising, is, this is hearing from more than just one CFO, is the amount of time and effort that gets absorbed in investor relations. So one CFO of a pretty large, well-known company said, Naveen, I just had no idea that 40% of my time is just going to go in, managing, our investors and their queries and so on and so forth. And I said, yes, because doing an IPO, is like launching a new product, right? You've done the R&D, you built it, now you have sold it, and now you're doing after sales service. So it's very similar. And that does take a significant amount of time, which takes away from their normal, ordinary day-to-day business and responsibilities that they have. So planning for that, making sure they have capacity and resources to tackle that. And I think my last one would be is you can't do it. Very rarely do you see companies do this completely on their own. You need help, you need counsel, you need the auditors, you need others. So my advice would be is, don't be shy and buy the best advice and money can get. It will help them in the long term in securing a successful IPO and sustaining the company as a credible investable asset for investors.
Yeah, great. Andy, Byron, thoughts on lessons learned?
Yeah, I will say disclosure is important. Really take the time as you're going through the IPO process to think through the disclosure that you're putting in the document. Not just think about how good it will make you look at the time of the IPO, but how it's going to look, 6 to 12 months from them, and how you will manage to hit those metrics, those targets that you've sort of identified at that point. I think the people that really, the companies that really spend the time, not just in preparation for the IPO, but in advance of the IPO, as they're preparing their board decks to think through those issues, tend to have an easier path once they go public and beyond.
Choose your board wisely and be careful to choose friends because they're your friends. You can choose friends, but they need to also be the kind of friend that will tell you the honest and unvarnished truth of a situation. You don't want any surprises, like I mentioned before, and choose diversely. You want diverse voices. The wisdom of crowds works very well on the board to have people who are going to listen to one another, and they need to be good listeners because you're going to have a lot of unforeseen activities in the course of pre and post public, in which you're going to need wise counselors to what both Andy and Naveen have mentioned. And those counselors could come through the board, or the board could help you select those counselors. Your compensation consultants, your attorneys, your auditors, all of this is going to be assisted by the board, and much of it's approved by the board, even at your direction as the CEO. So choose your board very wisely. I've seen it go very smoothly with a person who's a longstanding friend that the investors trust, and then I've seen it go very poorly with independents that are a bit celebrity-like, that attract attention, but they don't have the time to contribute to you that you need.
Great, thanks, gentlemen. So I'm going to incorporate or ask a few questions from our audience here. So maybe Andy or whoever else wants to take this one, sort of speaking to the delta of sort of expectations around price in the IPO to where price lands. What's behind that? Will that result in shareholder lawsuits?
So price to sort of first day of trading with the price. I mean, I think the underwriters always build in some expectation that there will be a pop on day one. I think part of it is they want to develop momentum.
Yep.
I think part of it is the obvious corollary to that is you don't want to price a deal and then for the stock to tank, because that's sort of where the lawsuits start to come in. And so I think there's always like a little bit of a fine balance of like creating enough momentum so that there's a pop, but not so much that it sort of goes off the rails and it looks out of touch with reality, I guess.
Mm-hmm.
Question about sort of bottom line costs to consider when thinking about the timing of going public. And I guess just we haven't spoken about timing, but any thoughts there?
Well, one significant part about timing is whether or not the markets are attracting retail investors in a given time. And so that's what, we've seen a slow market over the last year. There's a prediction of that there's a lot of, there's a lot on the table and ready to be deployed. We'll see if that is the case, but 2025 so far is looking promising. You want to get in that momentum cycle if you can, and if the timing's right for you going public, and so that's one aspect of it.
I think also is being ready. The market window to doing an IPO can open and shut in a very short space of time. So I think being prepared for that and being flexible with your plans. And if it means that, the underwriter that indicated that, end of Q1 would be a great time to go because, we're looking at the tea leaves and it indicates that it's heading the right direction, but suddenly something happens, market-driven events that do not support the valuation and investor activity and share activity for your shares, then delay it. Better to incur the cost of delaying a IPO for another quarter or two or even up to a year rather than making the wrong decision. And I've seen that happen as well. So I think market timing is important and being ready for that and being flexible to go for it at the shortest time possible is sound advice that, CEOs and CFOs generally try to make sure as they get ready for an IPO.
I'll just add to that. I mean, to being prepared. It's not the IPO. Even if you sort of have your board, you've sort of been preparing along the way. Once you hit the push the button, like, hey, we're gonna go. We're gonna get bankers. We're gonna have an org meeting. Even at that point, it's not something that you're gonna be ready to go in a couple of weeks. It's a on the magnitude of several months to get through the SEC and actually be ready to launch a deal. And so if you think that you want to do one, if you think you want to launch a price next year, it's about the time, you need to start thinking about that sooner rather than later. If that's
Great. Question, anyone able to share an example of a great IPO, recent IPO that you'd recommend folks take a look at as a case study? Anyone want to volunteer? Rumored IPO.
I can say the last IPO that closed was in end of 2021. It was Samsara, which was a great IPO and a great success story since then.
Great team.
I think that is a great one to look at.
Okay, so Samsara was the one we gave, Okay,
I'll throw one out that's been around a few years, and it's an interesting case study over several years, and it may answer a couple other questions I saw. Is Argenix, a biopharma out of Netherlands, but listed with us? It's had quite a ride, but not everyone's going to do what they've done. But they think very entrepreneurially, and they're humble and think small, but play big quite well.
Great, thanks, Byron. I'd also recommend for staying on top of. I follow Dan Premack's Axios newsletter on sort of great to sort of get a sense of where that market's going. What I want to do for the final takeaway, and thank you everyone. Sorry if we didn't get to all the questions. I want to give each of you the opportunity to either just share a key takeaway that you'd like to provide our audience with, or if you sort of are willing to take your crystal ball out and sort of tell us a bit about what you're expecting for 2025 in the IPO markets. I know, Byron, you're kind of bullish on it, but please, we'll ask each of you to do that for your final thought. So, Andy, we'll start with you.
I will say my crystal ball has been wrong every year for the last 3 years. So I don't.
That's why we practice law, Andy. We don't need
so I practice law, but I've been saying next year is going to be the year where the IPO, the tech IPOs at least start to flow. And I think there's definitely some momentum. There's definitely org meetings. There's people doing confidential submissions. Like it feels like we're in a little bit of a more positive environment leading into next year than I felt probably at this time last year. So from that perspective, it sounds positive. But I would say in the meantime, I mean, we don't know where the markets are going to go. And so all that we can do, as we talked about, is prepare. And as we've talked about here, it's not just for the IPO itself. That's a single transaction, but it's what life is going to be like as a public company post-transaction. So as a lawyer in the room, I'll say, your lawyer is going to, when you sign up to, start working on IPO, your lawyer is going to send a bunch of policies and governance policies and things of that sort. Don't forget about those things too. That's stuff that you can start working on now. So you can start developing the muscle, developing the sort of regulatory framework at the company to be prepared once it's time to hit go.
Great. Byron?
I'm not going to short to 2025, but it looks like, I mean, from our perspective, there's been so much pent up energy for a couple of years
Yeah.
that the momentum has built that direction, and then whether or not the politics actually steered towards more sort of funding more entrepreneurship, and that leads to more IPOs in 2025. It'll be yet to see, but that's the trend that we're seeing so far.
Naveen.
Yeah, I think you know, and aligned with what Byron and Andrew said, I think next year it's, you know, there's no clarity as such, but I think from based on the underwriters community and investor community who we engage with, there is optimism and there's definitely demand. You know, IPOs themselves are also considered to be an asset class for a lot of large institutional investors. So they do allocate money to investing in IPOs. And they have really not been the cadence of the number of IPOs that we've seen in the past. So there is pent-up demand. And there's also pent-up demand for companies that want to go ahead and do an IPO. However, you know, valuation is key and liquidity is key. So provided those two intersect, and which will indicate the market conditions are right, you know, once a few companies start following, believe me, they will all come, you know, in the stamping herd. One, I think, takeaway would be that for a company looking to do to an IPO is, you know, get ready to embrace change. You know, the public company, everything needs to be done faster, more accurate, more relevant, and timely. So I think changing the cultural personality of the company and embracing change to operate at a different level as it used to be in the past is going to be, you know, something perhaps a bit more intangible compared to the other things that people help you with. And being prepared for that to be a public company is, you know, will put management in a good position.
Yeah. Well, gentlemen, I want to thank you all for your time. Thank our audience. I believe Anna is going to be putting in some links, including a survey. We love your feedback. It's thanks for your time. And I will now turn it over to Colin to provide closing remarks.
Amazing. Well, thank you, Adam, Andy, Naveen, and Byron for providing such an amazing conversation around life as a new public company. Really, really tangible advice, solid stuff, and a lot of things for our founders to think about further down the line when they think about this as an option. So really appreciate your time, gentlemen.
Great. Thank you
very much. Thank you for having us.
All righty. For those of you still on, we wanted to thank you for joining us, and we hope this was insightful and helpful. We'd love your feedback. If you have a moment and interested in meeting with our partners, just let us know in that survey. Also, we're curious if this helped you gain clarity on the topic. So there's a last poll that we've got for you. That's just let us know if we knocked it out of the park. If you missed any of the portions of this session or would like to rewatch these videos, they were going to be available on our YouTube page. So use the link in the chat to subscribe. But on behalf of everyone here at the center, we appreciate you joining us and look forward to welcoming you all back online soon. Have a good one, everyone.